Good morning, everyone, and thank you for coming back here. Sorry we're a little bit late, but we will probably make it up, or we hope so. So we come to the second half of our Banking Supervision Forum today, and we will get right into it with a keynote speech by Michael Barr, Vice Chair for Supervision of the Federal Reserve. And Mr. Barr will be ready to take some questions at the end of his speech, so you can already prepare in your head what you would like to ask him. Mr. Barr, please.
Good morning, everybody. I was joking a little bit earlier that my remarks as prepared for delivery are released by the Federal Reserve at the time of this event, but it's noted as 3 a.m. So hopefully you all are a little bit more awake than that. My remarks today are, of course, only my remarks and not those of the Federal Reserve Board or of the Federal Open Markets Committee. Thank you very much for the opportunity to speak today. I'm delighted to be able to celebrate the retirement of Andrea Enria, my dear friend and colleague, who has done so much to strengthen the supervision and regulation of European banks throughout his career. In my remarks, I would like to provide perspective on some of the lessons learned from the banking stress experienced in the United States last spring for both banks and their supervisors. In particular, I will focus on how banks manage liquidity risk, the role of the central bank's discount window lending in this process, and the importance of robust liquidity planning for good times and bad. Last March, several large U.S. banks faced acute liquidity pressures when uninsured depositors looked at the bank's balance sheets and judged that they would be insolvent if the banks needed to liquidate their securities portfolios to meet potential outflows. The bank's poor interest rate and liquidity risk management triggered a crisis of confidence in their uninsured depositors, resulting in liquidity crises at these banks. In short, they faced old-fashioned bank runs, the speed of which was anything but old-fashioned. Despite their compliance with our capital rules, these banks lacked enough capital to reassure uninsured depositors that they had sufficient resources to weather this liquidity storm. In addition to our domestic strains, Credit Suisse came under renewed pressure in March 2023, after a long period of liquidity pressures that had been acute since the fall of 2022. Of course, Credit Suisse had been a troubled bank for some time, with doubts about its future viability after the Archegos and Greensill scandals had tarnished its reputation. These concerns became reality when the firm was forced to announce that its internal controls over financial reporting were ineffective and had been for several years. Credit Suisse was acquired by UBS in a deal that involved triggering of Credit Suisse's contingent convertible capital instruments, a severe dilution of shareholders, removal of senior bank management, as well as emergency liquidity support and extraordinary loss sharing from the Swiss government. While there is more that regulators and supervisors can do to help ensure banks' interest rate risk management and capital bases are sufficiently calibrated to the risks of their business models, today I will focus most of my comments on liquidity risk management and operational readiness for firms in the United States to utilize the Federal Reserve's discount window. This is not a new topic, and I have spoken about lessons from March and the importance of banks' preparedness to tap Federal Reserve facilities previously. Today, I will revisit those themes and provide some additional observations about the March stress events, including the importance of discount window preparedness relative to some specific liquidity risk factors, such as uninsured deposits. A striking feature of recent U.S. experience with bank stress was that Silicon Valley Bank and Signature Bank struggled to cope with unprecedented deposit outflows arising from a loss of confidence of their uninsured depositors. While ultimately the amount of their outflows made it not possible for these banks to continue operating, these banks started from a state in which they were not sufficiently equipped to manage liquidity risk, including by being adequately prepared to tap the Federal Reserve's discount window. Banks that experienced spillovers during this period also struggled with insufficiently robust liquidity risk management. It is crucial that banks have a diversified range of liquidity options that they are able to access in a variety of conditions. And in the case of banks that are eligible to borrow from the Federal Reserve, discount window borrowing should be an important part of this mix. There are a few major reasons for this conclusion. First, the discount window provides funding at a predictable interest rate, namely the primary credit rate, which does not fluctuate daily, unlike interest rates on private sector liquidity facilities. More specifically, the discount window is always available as a standing facility, with a primary credit rate currently set at the top of the federal funds rate target range. This rate, along with that of the standing repo facility, also set at this level, should serve as a backstop rate to short-term market interest rates and provide eligible firms with certainty about the highest rate that they will face to gain liquidity against eligible assets at any given time. The discount window provides ready access to funding that can help banks manage their liquidity risks. The ability to access funding at a predictable rate through the discount window should figure importantly into banks' liquidity risk management plans under a range of scenarios. The discount window is also an important tool for monetary policy. The primary credit rate set at the top of the target range is a component for how we can achieve rate control under a range of circumstances. To achieve our monetary policy aims, the discount window needs to be readily usable. If banks do not feel free to use the discount window when private sources of funding are more expensive, the discount window will not be an effective part of our monetary policy implementation toolkit. Banks have previously said that they are afraid of receiving negative feedback from their supervisors in the event that their grounds for tapping the discount window is that it is the most convenient or cheapest form of funding immediately available to them. In light of this, we at the Federal Reserve have been underlining the point to banks, supervisors, analysts, rating agencies, other market observers, and the public through numerous channels that using the discount window is not an action to be viewed negatively. Banks need to be ready and willing to use the discount window in good times and bad. The discount window is also an important tool of financial stability because the Federal Reserve can provide liquidity in an array of circumstances, including those when other sources are impaired. Liquidity provision through the discount window is not reliant on the smooth functioning of private sector funding markets. This is in contrast to most other options available to banks, including access in the United States to the Federal Home Loan Bank system. Moreover, banks that have pre-pledged collateral at the discount window and tested its operations are not dependent on other market infrastructure and payment systems to borrow against this collateral. These features mean that discount window preparedness provides additional diversification benefits that can meaningfully enhance effective liquidity risk management. The experiences of last March warrant reviewing again to gain better insight into how well banks are positioned to borrow through the discount window. In doing so, I will discuss some observations from March in greater depth and note some potential lessons to be drawn from that experience. I will also briefly note some observations on our work cross-border in collaborating with our international counterparts. The speed of the bank runs in the spring of 2023 were unprecedented. The failure of Washington Mutual in 2008, the largest bank failure seen in the United States before that year, was the culmination of stresses that occurred over several weeks. The deposit losses experienced by SVB were much greater in both relative and absolute terms, and they occurred in less than 24 hours. Digital banking and social media were factors in the rapid escalation of SVB's problems, though they were not the underlying source of vulnerability. SVB's concentrated and highly networked depositor base of venture capital firms, portfolio companies, tech and crypto companies, and high net worth individuals communicated quickly with one another and, in effect, coordinated the massive and rapid run. And more fundamentally, as I have said on other occasions, SVB failed because of a textbook case of mismanagement of interest rate and liquidity risk. This mismanagement made depositors lose confidence in the bank's solvency, and so they ran. The March stress also showed that contagion is possible among large regional banking organizations whose size and scope are well below those of banks that have been designated as globally systemically important. Liquidity stress at SVB quickly led other banks that were perceived to have weaknesses to experience outflows as well. Those banks that came under greater pressure tended to have large unrealized losses in their securities portfolios, to rely heavily on uninsured deposits, and to have a deposit and client base focused on the tech and crypto sectors, venture capital, or high net worth clients. But the contagion extended beyond such banks and threatened to cause disruption more broadly to regional and community banks with traditional business models and to the banking system as a whole. The Federal Reserve, the FDIC, and the Treasury Department stepped in quickly to stop that contagion, and the strategy worked. Deposit flows returned to normal, and stress in the banking system slowly abated. This experience has changed everyone's perception of the possible speed of bank runs. What occurred in 2 or 3 weeks, or in some cases many months in previous episodes, may, in the current circumstances, now occur in hours. These issues are top of mind as we review and consider future adjustments to the way in which we should supervise and regulate liquidity risk. We also saw during this period that firms were not as well positioned to monetize, that is, to borrow against or be ready to sell, their assets as they should have been. Many banks underestimated the size and speed with which liquidity needs could appear. Banks of all sizes are expected to maintain contingency funding plans to meet potential stress liquidity outflows. In response to the global financial crisis, regulators also now require large banks to maintain a multi-week buffer of high-quality liquid assets that can be easily converted to reserves during times of stress. These HQLA buffers are essential to ensuring funding resilience at large firms. The March stress episode, however, highlighted the fact that, in practice, there can be operational impediments to a bank's ability to monetize its liquidity buffers in large volumes and in a rapid time frame in acute stress. In a world in which a bank run took place over a matter of weeks, it was reasonable to assume that a sufficient volume of the most liquid securities could be monetized to meet the demand for reserves associated with deposit withdrawals. But times have changed, and I see several flaws in our previous assumptions. First, it may be difficult for a firm to conduct significant asset sales in a short time frame without becoming the subject of adverse attention, or if the firm is large, without affecting market prices with fire sale effects and potentially leading to broader contagion. Second, the March stress underlined the possibility that private repo markets may not be a viable financing channel for banks that need to rapidly ramp up access, especially for banks that may not regularly transact in these markets, even if such repo markets can be a viable source of liquidity for banks that regularly tap such markets and have more gradual funding stress. Sharp shifts in calls on private repo market capacity, particularly by firms experiencing stress, may not be easily met. In addition, it proved especially difficult to monetize assets in those cases in which firms held substantial amounts of longer-dated securities, with significant amounts of unrealized losses, as we saw in the experience of SVB. The experience showed that when these securities are sold and losses are realized, it understandably may send a negative signal to the market about a bank's viability. A compounding factor in these situations is that if the securities that a bank needs to sell are in held-to-maturity portfolios, the sale under acute stress can have a severe effect on the bank's balance sheet. While, as discussed, the discount window provides ready access to funding to help banks manage liquidity risks in normal conditions, it is also incredibly important that it be available to banks dealing with idiosyncratic or market-wide stress events. When other forms of funding or related market infrastructure are not immediately available, readiness to borrow via the discount window, including with pre-positioned collateral, is even more crucial. In contrast to private sector liquidity sources, the Fed can provide immediate liquidity against a wide range of collateral to one or a number of depository institutions simultaneously. This function provides additional time for more orderly monetization. An update on contingent liquidity readiness that the bank regulatory agencies published in July also makes it clear that all of the agencies understand the importance of a bank's readiness to make use of the discount window. The banks that failed because of the stress event that began in March had access to and utilized the Federal Reserve's discount window. And their failures were the result not of lack of access to the discount window, but of basic mismanagement of interest rate and liquidity risk that left them effectively insolvent in the eyes of uninsured depositors and unable to stem bank runs. That said, they also faced internal operational challenges in quickly identifying and moving collateral that would have provided them additional borrowing capacity at the discount window. While this additional borrowing capacity would not ultimately have saved these banks, given the speed and severity of their deposit outflows, the lessons from managing their stress events can help others facing less acute events. Greater operational readiness can provide for greater opportunity and optionality when a bank hits a bout of turbulence. Ready access to sufficient liquidity provides breathing room for a bank to determine and execute its path forward. There are two key aspects of discount window readiness: preparedness to access the discount window and pre-positioning adequate amounts of collateral. In terms of preparedness, the majority of banks that are eligible to borrow from the discount window now have the legal agreements in place. This is the first step. However, many of these banks had not recently tested their discount window access prior to the stress event. Engaging in testing through actual transactions at regular intervals is a key component of operational readiness. In the case of some banks, the amount of collateral pre-positioned was also a tiny fraction of potentially flight-prone liabilities going into the stress event. This lack of pre-pledging is a concern for several reasons, including that certain collateral types can require more time to pledge. Less liquid collateral can take longer to be assessed and valued at the discount window, meaning that banks should not expect that they can gain immediate liquidity against these assets. But these are the very assets that would be best pledged to the discount window, so that more liquid assets are held for other uses. The existing standards that require banks to hold HQLA buffers for self-insurance are an essential element of the regulatory framework. Requirements applying to large banks, like the liquidity coverage ratio and the net stable funding ratio, have meaningfully increased the resiliency of the banking system to liquidity stress and position large banks to deal better with a 30-day stress period. This type of self-insurance is critical to bank resilience and to the robustness of the financial system. However, these requirements may not on their own be sufficient to stem a rapid run. The speed of bank runs and the impediments to rapidly raising liquidity in private markets that may be needed in hours rather than days suggest it may be necessary to re-examine our requirements, including with respect to self-insurance standards and to discount window preparedness. The lessons from March also indicate that some forms of deposits, such as those from venture capital firms, high net worth individuals, crypto firms, and others, may be more prone to faster runs than previously assumed. As I have emphasized today and in two previous speeches, the discount window is a tool that banks can and should use to help them respond to a wide array of conditions and provide additional time for orderly monetization of liquidity buffers in private markets, but only if banks are prepared to use it. Given these dynamics, we are currently studying what the lessons from March and the variability in discount window preparedness across eligible banks mean for the safety and soundness of individual banks and for the stability of the financial system more broadly. Since March, some banks have been assessing their operational readiness to tap the discount window, particularly relative to their runnable liabilities, such as uninsured deposits, and have been taking measures to test and pre-pledge assets where possible. Banks have also been reassessing their assumptions on the liquidity value of held-to-maturity securities, given the experiences of March. Let me wrap up with some brief observations with you on international spillovers to liquidity stress events. Episodes of financial stress have in some instances gone hand in hand with stress in US dollar funding markets. Foreign banks, which have more limited access to dollar deposits than US banks and rely more heavily on dollar wholesale funding for their operations, are particularly vulnerable to dollar liquidity strains. Of course, these banks have an important role in providing credit in the US economy, and strains that they experience can affect US businesses and households. In addition, dollar funding markets are global, and so strains in one segment can have broader repercussions for market functioning. Foreign banks that have branches in the United States have access to the discount window. Outside the United States, some of these firms also have access to dollar liquidity from their own central banks. The Federal Reserve maintains swap lines with foreign central banks and also maintains the Foreign and International Monetary Authorities, or FEMA, repo facility to provide dollar liquidity to foreign official counterparts. These facilities have proven effective in damping pressures in US dollar funding markets when adverse pressures have emerged, pressures that could exacerbate strains in broader US and global financial markets. Indeed, during the global financial crisis and the COVID-19 pandemic, the peak outstanding amounts for the swap lines were a little above and a little below $500 billion, respectively, making them among the most used of our liquidity facilities. As with all backstop facilities, however, it is not just their use that helps the smooth functioning of markets, but banks and central banks knowing that liquidity will be available when needed, that helps to prevent liquidity hoarding and precautionary sales that can contribute to stresses. In part for this reason, the Federal Open Markets Committee decided to make the swap lines and FEMA repo standing facilities after initially setting the operations only up as temporary. These observations underscore the importance of our ongoing communication and collaboration with our counterparts, both other central banks and regulatory authorities, in order to ensure that we have a comprehensive understanding of evolving financial market dynamics and cross-border linkages that can affect our respective financial markets and financial institutions, and that we can work to address gaps before pressures emerge. In my experience, these cross-border collaborations have been essential in enhancing the resilience of individual banks and the robustness of the financial system. I am grateful to my colleagues for their collaboration and again wish to express my admiration for Andrea Enria and on his retirement. Thank you very much. We have a little bit of time for questions. I'm happy to take questions from all of you. Yes.
Thank you. Simon Ainsworth, Moody's. Central banks have struggled for decades, and possibly longer, with the problem of stigma in banks accessing central bank facilities at times of stress. I hear what you're saying about exhorting banks to make greater use of facilities and the recommendations you're making to others to understand that that usage is not necessarily a bad thing. But is there a more fundamental redesign required of how the liquidity facilities work at central banks like the Federal Reserve? You know, we know that the Bank of England made attempts to do that in terms of delineating its facilities more clearly to reflect which are those which are more LOLR, which are more standard use. You know, is just saying banks should use it going to be enough to deliver your goal?
It's a great question, and I think the answer to that is we're not sure. It is an area that we're exploring very actively. I do think it helps to have senior officials say very publicly and repeatedly that the discount window is available for use and should be used. We've also done that on an interagency basis. All three agencies have gotten together and explained that we expect discount window usage. We will not criticize discount window usage. We are also conveying that to supervisors in the field. and as I mentioned briefly, to analysts, to market participants, to rating agencies, to make it clear that we do not view discount window usage negatively in any way. Yes, sir.
Thank you. Alistair Ryan, Bank of America. Very clear speech. Thank you. So just banks have often used a surplus over their liquidity coverage ratio of 100% as a shorthand for showing you how liquid they are. What you've described is quite a different picture, that banks may have better or less good access to the discount window, better quality collateral, better pre-positioning. So is it wrong for the market to have been thinking that 130 LCR is great and 105 is bad? Because from your perspective, it might be quite different. The banks might have, you know, a very different other that's important for you. Thank you.
You know, it's a terrific question. So I do think that it's appropriate for the market to look to the LCR as an important signal of the liquidity of the bank. And so banks that have a significant buffer above their required LCR are more liquid. And certainly the experience with Credit Suisse this spring suggests that that institution had more time because it had buffers in excess of the required LCR, the minimum LCR, I should say. And that's true for U.S. firms too. So we do care about that level of self-insurance. It's a really important signal of liquidity at the bank. The point of my remarks is that it may not be enough if you have an acute stress period. And there, an additional signal of liquidity would be the fact that a bank has pre-positioned collateral at the discount window, has tested its operational capacity to use that discount window, and is part of their contingency funding plan. And so we do want banks to both have strong self-insurance and to have ready, demonstrable access to emergency sources of liquidity if they need it. And it's also, as I said in my speech, good. We believe it's healthy that if we see funding pressures in the market that are causing market prices to rise above the top end of the federal funds rate, for banks to use the discount window as a way of keeping monetary policy in an appropriate range. So both in good times and in emergency times, we think usage of the discount window ought to be viewed in a very positive light.
Thank you very much. Maria Tadeo from Bloomberg. I'm in the next panel, but I was very interested by the amount of times that you mentioned Credit Suisse. You also talked about the velocity of some of the bank runs, and you also just said maybe this institution, and I just talk about it as an example, had more time. But I think everyone can agree that it got caught in this very negative zeitgeist with perhaps amplified by social media in a way that it didn't apply before. So how do you end this cycle? Is there a way that you can end it? And I guess that if you go back, the bank would have said, perhaps things shouldn't turn out the way they did, but we just got caught in the zeitgeist. And do they have the tools to prevent a situation like that?
Thank you for the question. Look, I don't want to ignore the role of social media. Social media played a role in the March stress events. They played a role with respect to Credit Suisse and the U.S. institutions. We do social media monitoring to see how institutions are being perceived online as part of our risk assessment. So social media does matter, but that the role of social media can also be overplayed. Credit Suisse had underlying fundamental vulnerabilities, and they were hit with a shock, but if they didn't have those fundamental underlying vulnerabilities, they would not have disappeared. So I just think, the same with SVB. SVB failed because, not of social media, but because of absolutely fundamental failures of risk management with respect to interest rate risk and liquidity risk. Without those vulnerabilities, there can be social media chatter It's not enough to kill an institution. So we have to pay attention to social media, but also really focus on the basics of banking.
Thank you very much for your comments, and especially just following up on that very good point, paying attention to the risk management processes and interest rate risk and liquidity risk in the banking sector. One of the themes of this conference has really been about the regulatory perimeter and the non-bank financial institution market. And the comments about how much growth there has been globally, US and Europe, in the last decade, are, the numbers are staggering. How are you thinking about understanding the correlation risk and the lessons from LTCM in the current context when your regulatory perimeter is over the banking sector and you don't have visibility into that interest rate risk and liquidity risk and leverage outside of that perimeter and where it might be connected back?
It's a perennial question in financial regulation. We always have this question of what's inside the perimeter, what's out. How should you regulate what's inside given what's out? I've taught for many, many years a banking regulation class, and this is a theme that we explore over and over again in that class. And there's no definitive answer to the question. What we try and do is, first of all, gain better insights into what's happening in the NBFI sector. Collectively, we're doing that through the Financial Stability Board. We do that in the United States at the Fed and through the Financial Stability Oversight Council. So we have better insight into that sector than we did prior to the global financial crisis. We don't have perfect visibility, but we have much better visibility than we did before, and that's helpful. We also monitor the relationship between the banking system and the NBFI sector from the bank side. So we pay attention to how banks are doing, for example, at counterparty credit risk management, which is a key feature of protecting the banking system from those kinds of spillovers. We are paying attention to the buildup of risks in some areas. We are paying attention in the United States, for example, to the growth of the basis trade in the Treasury market, which is a highly leveraged position. It has many advantages in normal times, improving price efficiency, price discovery, in providing liquidity to the market. But if there are shocks to that, it can cause a spillover. So we pay attention to issues like that. The rise of private credit was mentioned yesterday. We do pay attention to the private credit market in the United States, which is both on its own but also funded by banks. So there's an important relationship there. We do in the United States also have a large non-bank sector providing originating mortgages. So we look at risks and the fragility in that sector as well. I could sort of go on sector by sector, but part of the answer is making sure that we know as much as we can and that we have a robust, strong system with very strong capital in the banking system, so that if problems happen in the non-banking sector, the banking system is resilient to those stresses. My clock is saying minus 2.39 minutes, so I think we're done with the Q&A, but it's been delightful speaking with you. Thank you.
A big thank you to Mr. Barr for your speech and for answering those questions. Thank you very much again for that. So this leads us straight into our next panel discussion entitled The New Reality, Banking After the End of Low for Long. The moderator of the session is Maria Tadeo. She already introduced herself just now with a question, European correspondent for Bloomberg. Maria will introduce the panelists, so please take it away.
Thank you so much, Connie. And again, thank you so much to Ms. Enria for putting together this conference and his team too every year. It's a pleasure to be here. And now let us introduce our wonderful panelists that we have today on this topic. On the far end, we have Claudio Borio, who is the head of monetary and economic departments at the Bank for International Settlements. Next to him, we have Steven van Rijswijk, who is the chief executive for ING. Stuart Graham, who is partner and the head of bank strategy at Autonomous Research. Mr. Jean-Pierre Mustier, who is the chairman of the supervisory board at Ariel Bank. And next to me, we have Professor Elena Carletti, who is professor of finance at Bocconi University. You also sit on the board of UniCredit. So thank you so much for joining us. Mr. Borio, the title of the session is The End of Low, now switching to Higher for Longer. I wonder if you could perhaps take a step back and give us a setup of what this has meant in practical terms.
Kind of big picture. Yes, absolutely. Let me start by saying, well, first of all, that I'm delighted to be here for what is Andrea's, Enria's last ECB Forum as chair of the SSM. I'm sure he will be back plenty of times in the future. So let me say that clearly the end of low for long is very good news for banks. It provides an important boost to net interest margins and therefore underlying profitability. I'm sure they were looking for this for quite a long time. Having said that, I think that there are three buts. The first but is that the transition is going to be bumpy. Mm-hmm. The second, and I'm sure we will hear much more about that later, is that there's still some very important underlying structural weaknesses in the banking sector that we have not been able to sort out. And that has to do, and that is reflected in particular in very low price-to-book ratios. And the third, I will not say it now, I will basically mention it, save it for later to keep the suspense going, but it's about a very important long-term challenge that the banking industry is facing. So let me elaborate on the first, the bumpy road ahead. And I think it's important to realize, I'm not sure how many people do, that the situation that we are facing is unprecedented by post-war standards, Second World War standards, and in fact probably unprecedented even going further back. And that is that for the first time we are witnessing recession risk. There is clearly recession risk around the world, while at the same time in the context of the conjunction of a strong monetary policy tightening to bring inflation down and widespread financial vulnerabilities. And by widespread financial vulnerabilities, I really mean in terms of the big picture, the fact that debt levels are historically high, that asset prices are still quite elevated, and we're coming out of a very, very long period of exceptionally low interest rates. So we're really seeing what the legacy of that is. And let me clarify what I mean by unprecedented. If you look at the post-war period, particularly for advanced economies, you can see that there is a very clear divide in the mid-1980s in terms of the types of recession that we've had. Until the mid-1980s, the recessions were largely driven by higher inflation, monetary policy tightening, and that had to bring the inflation under control. But the financial system was repressed. And the fact that the financial system was repressed meant that there was little scope to see the overt financial instability that we saw later. Following the mid-1980s, the financial system was liberalized, central banks and structural forces brought inflation down, and therefore the types of recession that we saw were more like the result of big financial expansions, strong credit growth, strong asset price growth, strong risk-taking, that were basically generating the subsequent contraction. And the GFC is the greatest, the most obvious example of that. So that we shifted from what were inflation-induced to financial cycle-induced recessions. What we're seeing now is the combination of the two. And this is sort of raises some important questions, because first of all, we haven't seen it before. And second, of course, the room for maneuver for central banks is much more restricted than it was during the second phase. Now, it's important also to realize that what we have seen so far is just the materialization of interest rate risk in the United States, in the non-bank financial sector. And I would say that Credit Suisse was a bit of a bystander, a bank that had a broken business model and then was caught in the turmoil. But what's ahead of us, and it is ahead of us, is the materialization of credit risk. And the only question is when and how intense, and whether the banking sector is prepared to sort of deal with it. Now, there is a certain, what I would call, impatience illusion here. I mean, the lag between the materialization of interest rate risk and of credit risk can be quite long. So how strong is the financial sector? Now, in that context, the first question to ask is how large can the losses be? Now, and some analysis that we've done at the BIS, which roughly is similar to what the IMF has come up with, is that the actual losses that could be ahead of us could be quite large in a stress scenario. So if you assume, for example, that interest rates could be, say, 200 basis points from where they are now, or have been recently, then the type of losses could be as high as those that we saw during the great financial crisis, in a very sort of outside scenario. Now, of course, the banking system is much better capitalized. It's much better capitalized than it was before the GFC. Having said that, if you look, for example, at credit ratings, whether you look at standalone ratings or all-in ratings, they have actually deteriorated since the mid-2000s, 2010, actually, after the, roughly since then, obviously, since the great financial crisis as well. And one unknown here, I would say, is, and this came up in a number of cases before, is the exposures and the state of the non-bank financial sector, because the exposures to that sector tend to be rather opaque. That sector has grown in leaps and bounds since the great financial crisis. That was partly intended. But still, there is hidden leverage, there are liquidity mismatches in the sector, and what was not intended is the fact that the regulation, the prudential regulation from a systemic perspective in that sector has lagged behind.
Well, thank you for that, and you gave me a perfect segue to the next question for Professor Carletti, because Claudio just talked there and he said we've only seen a minor part play out. And I know that you and I were talking behind stage where you said this change in cycle and the tighter policy, it's not just rates, there's a whole universe around it. What do you mean by that, and how does it affect banks and financial institutions?
Thank you, Maria. First of all, good morning to everyone. I also want to thank in particular Andrea for the invitation to this conference. It's a pleasure and an honor to actually be here and be able to speak on this occasion. So let me come to the question, just to complement what Claudio said. When I mean there is more than rates, I mean we are going across a period of tightening of monetary policy more generally. And when we look from the perspective of banks, they have already been taking some action that have affected banks quite importantly. For example, the change in the condition for the TLTRO funding, or the change in the remuneration of the minimum reserves, and now the current discussion on how big these minimum reserves should be. So far, let me say, the banking sector has gone through these changes quite well, in the sense that in aggregate, there were issues concerning, for example, cliff effect related to the change in the condition of the TLTRO, but this cliff effect have not materialized, or at least not yet, using the words of Claudio. But going forward, there may be some asymmetries and heterogeneity, in particular in terms of small versus large banks or across jurisdiction, depending on how much the various the banks in the various jurisdiction were actually relying on the use of central bank funding, for example. So at the moment, a little bit of an increase in cost of funding, a little bit of missed gains in terms of lack of revenues from the remuneration of minimum reserves, but not substantial effect. But going forward, in particular on the uncertainties that monetary policy is creating on some decision like the size of the minimum reserves, this may have an implication. So it's very good in that sense that the supervision is within the monetary policy, that the two can talk to each other and can really take a sort of a holistic approach as to what a monetary policy decision should be.
Perfect. And now let's go to Mr. Van Rikswijk, because in your recent earnings that you put out, and just to cite you, you say, and it goes perfectly into the title of the session, you say the cycle of central bank hikes has obviously affected positively the profitability of financial institutions and banks, but you also say this appears to have paused. And what it seems to me is that you're saying it's not a sustainable growth model just to focus on that one aspect. So I wonder first a general question as to how you believe this change in cycle has meant for banks, but also what happens next, because based on what you say here, no longer you've gone from low, it's over, higher for longer, but you're already thinking what comes next.
Well, I mean, clearly interest rates have been negative for quite a long time, and I think it has now benefited the banks that interest rates went back to, let's say, positive levels, but also with a positive interest rate curve, which we haven't seen for a long time. So although we think it is good, many people are a bit surprised by it, and I can understand it, because it hasn't been there since 2014. So that is certainly, when that changes so rapidly, then it will cause some nervousness in the markets or nervousness with the population. Still, I think it's good that banks have good profitability. And at the same time, what you do now see is that with the pause in rates of what the ECB has announced, or what the Fed has announced, that, and we have seen it in previous cycles, that interest rates and also deposit rates gradually move up. That's just a given. We've seen it in all the cycles in the past. I think the main difference for what we now see compared to what we saw in the past is that the interest rate increases from, let's say, minus 50 basis points to around 4% took place in a matter of 18 months. In the previous cycles, these hikes took place in approximately 3 to 4 years. So the speed with which interest rates increased was dramatically faster than we saw in the past. That's also a bit the disruption that you're talking about. And what we see is gradual competition coming back. Banks look, of course, at their balance sheets and their own businesses in the different countries. So for us, that's different in Germany than in the Netherlands, than in Belgium, than in Spain. But still, you see gradually, and depending on, let's say, the balance sheet composition, the amount of assets and liabilities in the market, the way that your strategy is in terms of trying to acquire new customers, the products that you want to feature, that then causes competition, and therefore it's a matter of time before interest rates move up further. And the speed of which, again, like I said, depends on competition. That's why I said it.
Okay, excellent. And can I just ask you, just to go back to what you say in your own earnings, you do say so far it has been good for profitability, but you also suggest it appears to have paused. Should we read that as the positive effects, the implications for banks? This is not going to ride through into 2024. You need something more in the strategy. It's not just a sustainable growth strategy to depend on higher rates.
Well, I mean, look, clearly, I mean, I believe I'm here in the house of the people who determine the rates. So the question is also more, to the monetary side of this institution. But basically, based on the announcements that were made by the ECB, I made that statement. Clearly, and that goes for our bank and for a number of other banks. But if you look at ING, we are 80% of our revenue comes from interest. I will not complain. Over the past 12 months or so, we have been held by the higher interest rates. But if you look at any business model that has 80% dependency on one type of input and 20% only on other inputs, which in our case is commissions, you have a business model that you can still improve in the balance. And I've always said when I started in my role that I need to improve that balance, and we will keep on working on that.
Well, thank you for that. Mr. Graham, I wonder, what are your thoughts so far that we've heard on the panel? And I wonder, we talked about this improved profitability, which is obviously tangible, and we've seen it reflected in earnings. But then why are valuations perhaps not more attractive? What is the reason behind it then?
Yeah, look, I think there's 3 reasons really. One is the perception that European banks are over-earning because interest rates have gone up very quickly, and as Stephen said, deposit costs have to catch up. So there's a sense that they're over-earning on net interest income and they're over-earning on asset quality. Bad debts are going to go up, and obviously nobody knows how much that's going to happen. The second is financial repression, whether that's banking taxes or MRR, this sense that shareholders own the losses but don't own the profits. Somebody else will take that away from them. And then thirdly is muscle memory. Just European bank equities have been a very bad investment for investors for a very long period of time, and that kind of mental scarring takes a long time to go away. There's this perception that somehow European banks or European policymakers via the banks will always find a way of disappointing you. So I think people are very reluctant to buy into a this time it's different argument. I mean, if we look at the, I think we'll come and talk about the financial repression one in a second, but if we talk about the over-earning, I spend all my days talking with investors. Every conversation I have is how much is net interest income going to decline 2024 and 2025 versus 2023. So everybody knows it. It's just a debate about, do you think the deposit beta is going to be 40, 50, whatever you think it's going to be. So when you look at the cost of equity at the moment, which we calculate is about 16%, that's simply the inverse of the consensus earnings expectations. And it's another way of saying the market doesn't believe those earnings expectations. I guess the good news is, if you think of those three items, muscle memory, it's kind of backward looking. As long as European banks deliver, it should fade. On the, are they over-earning? Well, we're going to find out in 24, 25. I mean, we'll work it out, how much asset quality deteriorates and how much interest rates, cost of deposits catches up. And in terms of financial repression, well, quite a lot of people in this room have quite a bit of input into that. So if you want to stop that one, there's something you can do about it. But maybe we leave that for later in the panel.
We are going to talk about it too. I have a number of follow-up questions just on what you said, but we'll do it later. Yes, go ahead.
Can I add to that? So indeed, sometimes it depends also on societies that it's being said that, okay, there is now the case of over-profits being made. And it's always a bit difficult, since it becomes quite quickly very technical to say, well, let's look at the past 10 years. Let's look at the profitability of European banks compared to what we see in the past 12 months. And the 30 seconds that you get where the media said, well, your time is now up, and so let's move on. But let's also not forget, and that it was due to it was impacted, of course, by the monetary policy of the ECB, and by the way, for the right reasons. Let there not be a mistake to actually decrease the interest rate. But it just has meant that banks' profitability of European banks have come under pressure for a long time. Even the rates in Europe started to become negative in 2014. It was only in 2020 when we started to discuss at what level can we also charge or pass on negative rates to customers, and then only with thresholds of, in our case, above 100,000 euros. So it took 6 years for us to move to a negative interest rate territory. Now, luckily, I mean, negative interest rate as a concept is already something that is quite difficult to understand in real life. So that has taken a long time. And also, and that's the second technical argument, of course, in our balance sheet, we have long-dated assets with fixed patterns in them, and therefore a pass-through of higher deposit rates compared to a pass-through or, let's say, revolving of your asset book is a complete different factor and takes much longer. Now, as you can already figure out, and you're already looking at me like, what are you saying? It's very technical, and it takes a long time. So that story is difficult, and still I'm going to repeat that story whenever I'm in the media in as simple way as I can. But I'm also happy, also, Andrea, that you sometimes say something about it, because it just helps if a more impartial party like the ECB says these things also in public.
But I think Bloomberg gives you more than 30 seconds. But nonetheless, we'll give you more time next time, but also there's an hour now. So that's good to go into more details, for sure. Jean-Pierre, so far, well, I wonder if you have any thoughts of what's been discussed so far. And I wonder, you have an enormous experience in banking. In this change of cycle, how would you play it strategically, the changes that we've seen over the past year?
Well, I would like to, first of all, thank Andrea for having me here. He's a wonderful person, but I'll comment about it later. So at least he doesn't kick me out of the room before I speak. But I would like to come back about what happened during the negative interest rate period, and then what we could look at now that rates are normalizing. During this negative rate period, bankers had to cut costs, work on raising capital, changing slightly their business model. In the meantime, which was the largest by market cap financial institution in continental Europe in July 2021? BNP? Santander? No. It was a fintech with 2,000 staff and 200 million euro net income. Market cap? 71 billion euro. It's called Edion.
Yeah.
Now its market cap is 25 billion euro. So when we bankers were cutting our costs, when we were looking to raise capital, we just missed 72 billion euro value creation because we were not looking at what was happening. We were right to cut costs. We were right to raise capital. But what can we do in the future not to miss this 72 billion euro value creation? And I think that when rates normalize today, we're saying, well, the best strategic development for a bank is to buy back shares. Fair enough. Buying back shares is the best ROE creation deal you can do. You have a 13% return on equity, you buy back shares at 50% discount, 24% ROE transaction, nothing beats that. But it's very short term. In the meantime, do we have another Edion going to develop something? Probably not. Because now that rates are higher, Edion or the fintechs cannot fund themselves. And so the benefit of higher interest rate is to generate more net interest income on one side, but open up the game. And so should we think about a new strategy for bank, and how can banking supervision support that? What I'm going to say here is easy to say because I'm not a bank CEO anymore, so I can say things that I will never apply, okay? So that's fine. But nevertheless, we need to think that bankers are now car manufacturers. It's an insult to some bankers, maybe a compliment. I don't know how you look at car manufacturers. Why? Because we could use OEM, meaning fintechs, to provide us with verticals that banks will not have either the resources or the critical size to develop. And let me give you some examples, because I spent the past 2 years to look at fintechs. For one of the SPAC we raised, we didn't invest in the SPAC because we felt the valuations were wrong, and we were right not to invest because the valuation have collapsed. But I saw 132 fintechs in the past 2 years. And I can tell you that there are a lot of business model verticals today that banks can use in order to complement their business model instead of willing to develop them internally. Take a stake in the fintech, have them to provide the service on a white label and develop. What are they? Some examples, and I'm very happy to elaborate privately afterwards. Look at payments. I mentioned Edion. But there are very interesting payment businesses. One of the most antiquated payment activity in the banking sector is cross-border payment when you go outside of the Eurozone with correspondent banking. It is ridiculous. It is ineffective, it is long, and it is expensive. There's a wonderful fintech called Banking Circle, which has a banking license and is developing cross-border payment on an extremely effective basis. What can bank do? Do you want Banking Circle to be the next Edion, or do you want to look at it in a very creative way? Let's look at e-commerce. On e-commerce, you can develop working capital financing, working with fintech, in an extremely effective way, where you have almost zero risk on the credit side because you get, each time there's a payment, you get reimbursed. The return on equity on this business is 24%. It's not bad for a financing business. And you have a lot of fintechs doing that, where banks can be involved. Let's look at insurance. There are wonderful fintech on the insurtech side, which can be wonderful complement to a bank business model. Alan, a French fintech, the French, I won't tell you about it. Life would be so much better without the French. They were saying it in the credit. But, Alan is a very, very good fintech, which if I'd known them before, I would have been offering them within the network of the bank. In Italy, in Germany, we are not present. And their offer is absolutely unbelievable. Rather than doing a joint venture with AXA, with Allianz, or whoever, the quality of what is offered here is super good. You can do the same for car insurance. You can do the same for pet insurance, for instance, or others. There are very, very good business models there. Let's look at wealth management. You have some fintech today which offer absolutely unbelievable wealth management offers, which are cross-border, super effective. I can tell you, if I had known the wealth management companies I looked at to invest in, and I was really willing to invest in them, I would have replaced 2/3 of the private banking staff of UniCredit just to offer their platform. And the quality of service to the client will be unbeatable, unbeatable. And now let's look at the last example, and afterwards I shut up. Yes, it's benefits and reward services. Benefits and reward services. It's a banking business. What do? They issue credit cards which are targeting specific services, meal, healthcare, or well-being. What do these companies do? They have a payment business. They have a huge float. You look at Edenred, which is listed, so you can have an example. And Edenred has 500,000 corporate clients, 2 million merchants, 35 million individual clients, and a 6 billion float, where they pay 0 interest because it's prepaid card. So what should banks do? They should develop a benefits and reward services business. A fintech is doing that. That's been bought by a French bank. And I'm sure that they will develop very well. So what I'm saying here is that we should look, and the regulator should look at it, because it's a supervision issue to start with. Can banks develop their business by having verticals, so to a certain extent outsourcing part of their business to a third party, which is, from a supervision point of view, not an obvious answer. Because you take operational risk, you take the risk of making sure that the offer is going to work. But I think negative interest rate blinded us in terms of development. The normalization of rates blind us in terms of short-term strategy. We buy back shares, but what will be left afterwards? And as you mentioned, rates are not going to remain too high and might go back down. And we have a window to rethink the bank business model, because I think there's zero chance in Europe that we will have big bank mergers, because it does not make sense to have cross-border merger in Europe for big retail networks. So we need to think laterally and differently about what we can do. But I'm not a bank CEO, and I leave that to the bank CEOs to do that, and to the regulators to think about what to do.
But can I just ask as a follow-up question? Because it seems to me, on the one hand, you seem very excited about a number of areas, but you also it seems there's still perhaps an element of disappointment where you go back and think in the past, there were opportunities that were good, but you see we're focused perhaps on just cutting costs and a number of other issues that prevented us from perhaps seeing the future. And you said the word, perhaps we were blind in the past, but how do you stop being blind in the future? The sense that I get from what you say is that you believe parts of even this debate are antiquated, perhaps.
Well, I think that, why was I blinded? But any other banks here were blinded, because nobody created Adian. So, 72 billion, that's a big miss, okay? So I think that bank CEOs are focused on the short-term issues, and very few people in a bank are telling them, look, you can think laterally. I'm going to give you a last example, which is a provocation, but I could not resist. In 50 years, Andrea will be in paradise as all good regulators. I will be in hell as all bankers. And we will be discussing the impact of the digital euro, which will not be capped anymore, but which will replace all the euros, and banks will have no more deposit. So the bank business model in 50 years will be a business model where, if the digital euro develops, which I zero thing, I think that it has all the chance to develop, and I zero doubt that it will not develop. The cap will be removed. The deposit will shift towards an asset. The bank will have to fight for deposit. They will price their deposit in a real way, because today they don't price their deposit at all. Monetary transmission will be wonderful, because it will be immediate, basically. And banks will have to manage their balance sheet in a completely different way. It will be in 50 years, and Andreas and I will be having a good time looking at the successors of Claudia, Andreas, and others, saying, luckily, it did not happen when we were there.
I see a lot of reactions, so yes, let's, Claudia, you can go first.
Just a point which I think complements what you've just said. Clearly, it is very important for banks to rethink about their business model. And at the same time, we know that in what you might call the traditional banking area, there is overcapacity in Europe, and that there is an exit problem. That exit problem has to do with the nature of banking. It has to do with politics as well. And I think that somehow that issue will have to be addressed. Now, looking forward as opposed to looking back, I think what you just said is absolutely essential. And we should not forget that there is a huge digitalization, call it revolution, which is going on. And that offers lots of opportunities for banking, but it also offers, it generates a number of threats, because there are people outside the banking area that are actually have been much more nimble to exploit them. And yes, there is a sense in which one can imagine that a retail CBDC might be an issue, but it depends very much how it is defined, how it is designed. And on the other hand, one can think of the provision of a digital currency, particularly at the wholesale level, as providing huge opportunities again for banks. You can imagine a future in which you have tokenized CBDC at the wholesale level. You have tokenized deposits, as some countries are already doing. And on that platform, you can tokenize assets. And all of that would generate huge opportunities in terms of the ability to generate new types of contracts and new type of profit opportunities. But you have to be nimble enough to take advantage of that.
Thank you for that, and now, of course.
Thank you. I just want to go back to something that you said. So first of all, I fully agree with you that in the moment when banks are sort of rethinking about how to make their revenues sustainable, as Stuart was saying, this is still a big impediment in the price to book. Going for vertical business or trying to find opportunities, whether it's cooperation, whether it's acquisition of fintech, of other entities, is fundamental. And I think boards and CEOs are currently, maybe we can hear CEO later, but they are currently doing it. But there is one aspect in which maybe I slightly disagree with you. As a former board member of you, maybe I constructive challenge you.
We always agreed together at the time, but anyway.
No, I just want to say one thing, which is I wish to believe that the share buyback maybe is not just an issue of short term. I wish to believe, and I hope not to be wrong, that the share buyback in the short term is a boost to increase the price to book, increase the attractiveness of the sector, and therefore give the possibility to banks to do even more this type of thinking that you have in mind than if they have a very low price to book. So I hope this is the way in which the share buybacks are used at the moment. It's not just a matter of increasing short term, but it's a matter of making banks more sustainable in the longer term and more attractive in the longer term.
No, but I don't disagree with that. I'm just saying share buyback is a tactical approach.
Yeah.
It's not a strategic answer to what the banks are doing. If you push your thinking to the end, there will be only one share remaining or zero share of a bank, and they may
there will be There will be, of course, a limit to what this can be done. But I wish to think is a mean for a longer term vision. It's not just a short term.
Yes and no, because as Stuart was mentioning, you cannot just keep your share price high because you buy back shares. You need to, keep your share price high because you show growth, an efficient business model, which is de-risk, etc., etc.
Sure.
So the transformation of the business model needs to happen.
No. They have to come together for sure. Yeah. They have to come together.
I am loving this panel. CEO in the room, I know you're, Mr. Van Rysbeek, you're putting your hand up. The floor is yours.
Yeah, there's so much I want to say.
Already okay.
Let me try to box myself. So, clearly, we need to continue to work on growth and development and diversification of our businesses. In all honesty, even in the times that interest rates were low or negative, we have invested considerably in all kinds of fintechs and the likes, some of which have not turned out to be too good of a success. And that's where, just if I say euphemistically, and there comes also the crux of the matter in the fact that we are also, first of all, there to keep our customers safe. And there is a limitation also in the construct of regulation, and that's that tension, in that field of tension I struggle, to be honest. Since on the one hand we want to diversify, we need to do that in a profitable way, because if we do not make our returns, then the question is, why do we invest in things that are sub-hurdle? And that's a logical question when you're subject to the pressure of the market. And in that setting of how then to be able to grow, I think that there was a part of it, the speech was partly, or question was on your speech on non-bank FIs. We've seen in Europe that the total, and that's only the balance sheet, I just named this as an example, not only about non-bank FIs, that if you look at the total size of business lending in Europe from 2008 to 2022, I think those are even ECB figures, that grew from 7.3 to 10 trillion. And of that, more than 80% came from the non-banking FI sector. As a matter of fact, and people often say that in Europe business is largely a banker's market, but if you look at total business lending in Europe, 52% already comes from non-bank FIs. Now, and that means that within a very short period of time, part of what's happening in the world is taking place outside of the banks, which is impeding on growth. Whether the society likes it or not, I leave it in the middle, but that's one of the struggles. If you look at the number of the developments, whether it is in crypto or DLT, then for the right safety reasons, we are limiting ourselves, and supervisors are also warning us to be careful not actually to play around with it. And by the way, I fully subscribe to it, and I'm very careful to introduce any Bitcoin services to any retail customers in any of the markets in which we're active. Wholesale is a bit different. But it also means that also part of that playing field is outside of our sector. And I can name a few more, but I will not do that. So in the end, and we need to have that search for growth to the development for the markets in which we operate in the real economies. But the question is, where do we strike the balance between being safe in our own right, but sometimes it's described as a waterbed. You push here and it comes out there, but out there is not with us because we're not in it. So I'm all for safety, which is very good. I was not a CRO for nothing in my previous life. But we need to balance it also with where do we think banks can fulfill a core role? And whether that's all the fintechs or not, I want to park the debate, but I think it's important that we also keep looking at where can banks play a role, and of course then put the bells and whistles around it to keep us safe. Go ahead, do you have a question?
No, I just had a question because you've used the word safe and safety many times in your answer now. I wonder basically, that's the issue when your clients go to you, where the average person that banks with ING, that's what they value the more. So everything else in this universe, it maybe doesn't speak to them. So the appetite is not there. So your business, it's positioned in a different way to some of the other opportunities. We're talking about different things.
Well, partially, because it's not about safety or, it can be safety and. Mm-hmm. And I think what I'm trying to advocate is it can be safety and, so let's also make sure we create the room to invest in new things as well, a bit to what you said. In that setting, by the way, and you talked about digital, 62% of our customers we deal with only through the mobile. We have 38 million customers. 97% of our interaction with the customers is only digital. So we can be digital without being a fintech. We do, by the way, collaborate with a number of fintechs, and we do, by the way, put a number of their solutions in place when we can. But in the end, digital is also a means to an end. It is something about getting a superior customer experience. It's either easier or instant or personal or relevant. And digital is an enabler to it. It is not a means to an end. Let's be digital. Now we're digital because we can provide a better service to customers. And in that digital, the question is, how far do you then go? And can you do more than that you do now? And are there limitations or inhibitions that we see as banks, and I think that is indeed the case, that other companies don't have? And that's why we need to find a middle ground. I also want to say something about M&A, if you allow me. So I would love to do M&A, well, when it makes sense and all this, before you know the analyst community. and I've said, but there is also, and you are a European, Andrea, and I'm the same. But in the bank setting, what we do still see, and that's just fact, that's not views, there is compartmentalization of capital and liquidity, and that is an inhibitor for European consolidation. Even if you would make an acquisition, also given the fact that the interest rates have grown so quickly over the past number of months, it means that from an accounting point of view, you have to basically write down your existing mortgage book, and as you may know, ING has a considerable mortgage book which is largely fixed rate in Germany, in Belgium and the Netherlands. That means that if you make these type of acquisitions, you write it down because you have invested in mortgages at rates which were considerably lower in the past than now. And of course it will come back to you over time, but on a day one acquisition, from a day one acquisition point of view, it can have such a negative capital impact that it just makes it impossible to do an acquisition. And we need to solve those things. Now, unfortunately, personal opinion, I think there are more non-Europeans coming to power these days, and I think it's important that if we want to maintain also for the stability and the fluidity of the capital liquidity in Europe, we need to have one Europe. So I'm not too optimistic short term about the direction we're traveling into, but that needs to be fixed, and the accounting needs to be fixed to get to that cross-border M&A setting that people would like to make the banking sector in Europe healthier.
So you think this idea of European mega champions and this massive cross-border operations, we've heard it for many years now, and hasn't fully materialized. Well, you say you sound still pretty downbeat. You're not very optimistic.
I know it's Friday, but yes, yeah.
So what's going to change this now that you have? You're at the ECB. So what would you like to see realistically to change at least the tone finally?
No, well, this is not the message for the ECB. I think the ECB has given all the right messages. Okay. As a matter of fact, we have been speaking about it now and again, how to do something about it, but it's damn hard in Europe, and we need to continue to find that path. I think we need to continue to advocate it. I'm very happy with the way that the ECB advocates that view, and I think we should just continue on that path, because in the end, that will be better for Europe.
Both Stuart and Jean-Pierre, I believe you had comments you wanted to make, but Stuart, if we'll go with you first.
Yeah, I just wanted to sort of make the point, I agree a lot with what's been said, but I don't think it's either or in terms of share buybacks or investments. I mean, if you look at the profitability of European banks, if you say they're going to make a 12% return on tangible, let's say risk-weighted assets grow at 3%, you can do an 80% payout, 50% cash, 30% share buyback. That should be reasonably recurring. When it comes to, on the investment side, I think we have to face facts. Banks are not very good at technology. I mean, if you look at the amount of money that banks throw at technology, if you say most banks spend 10% of revenues on technology spending, let's say about 40% of that is so-called change the bank, those figures dwarf anything that Adyen and co do in R&D, and yet the bang for buck that banks get for it is not terribly good, and we can kind of go into why that is that case. That's not to say they shouldn't do it, and not to say that investors will look for banks to come up with some longer-term growth outlook, but I think we have to accept that there's a kind of a skill set shortage and sort of institutional barriers to expecting a great deal of success out of that. So, as Stephen said, M&A is damn hard, but I think expecting banks to reinvent themselves technology-wise is probably damn hard as well.
And just a quick follow-up. Before you said European banks had a part of perception problem. I wonder if you could elaborate more on that, but I guess more to the point, how to change it.
Well, I mean, unfortunately, I don't think it's a sort of silver bullet, but I think the way to change it is if we're saying that banks are over-earning and when rates come down, they won't make as much money and banks will have some bad debts because of the macro, we're going to see that. So, that'll play itself out in the next couple of years. So I don't think there's anything that the banks have to do there other than show their resilience. And my personal view is I think they will be resilient, and I think the problems will be probably in the non-bank space or somewhere else. But let's face it, if we're going to get a recession, this has been the most talked about and most anticipated recession of all time. So you'll be a pretty dumb chief risk officer not to have kind of thought about many different opportunities, I would have thought. And on the muscle memory issue, I mean, eventually, if they keep buying back shares and they keep delivering, I mean, we've calculated if you assume that the sector has an 80% payout ratio for all time, and I guess maybe people in this room might disagree with that, but if they were to do so, then basically the current market capitalization, €1 trillion, you will get €1 trillion back by 2029. So when we sit here in the 2030 symposium, either the share prices are much, much higher, or we were very wrong on the earnings outlook, but something is wrong with that mathematics. Our bet is it's the share prices that are wrong. Let's hope so.
Okay, interesting.
Just a few comments. Just going back to the technology side, I am convinced that banks will not be able to develop internally the verticals I mentioned. This is why I think the business model is car manufacturer, where you use OEM who will provide the verticals. It's a banking supervision issue. How do you allow banks to do that, to have suppliers basically for their business model? And when you look at how these fintechs develop, the agility, the mobility they have, and the ability to fine-tune the product for the client satisfaction side, I think it's super unlikely that banks will be able to do that. And I mean, I wasn't able to do that, but there are much better chief executives now, but nevertheless, I think it's very difficult. The second point is on M&A. In Europe, we have a fragmented market. If you look at European GDP, not very different from the US. If you look at the number of customers, not very different from the US. But on the retail side, you have 16, 18 different markets. It's extremely difficult to generate synergies between different retail businesses. So, I don't think that bank M&A is going to really create value when you look at it and compare it to share buyback. Share buyback is very good now, and I've never said the opposite, but it's not an end in itself. Okay, you need to look at how the business model develops, because the sustainability of the PE will be based on the ability of banks to show growth and proper profitability. So share buyback is a way to push up the price short term, but when you stop the share buyback, you're like the bunny, and you look, and then you go down on the cliff. So you basically have to see, and I'm on purpose, being, exaggerating a little bit about the shift of the business model. There are much more important things to do in changing the bank, but I think that we need to think a little bit laterally in order to see there are alternatives. Otherwise, there will be new ADN, and the banks will miss this immense value creation that we have missed on the e-commerce side.
And you also mentioned, and we hear this repeatedly, when you look at the big numbers, the difference between the US and Europe is actually not that different. But again, when you go back to valuations, even perception of the idea of who are the big champions.
No, but the big numbers between Europe and US are not different on a consolidated basis. But we have series of individual markets which are segmented. So you cannot develop, there is zero synergies between two retail banks in Europe, zero. Okay, so doing M&A for the retail business is impossible, except if you have a digital offer. You have a very good wealth management business. I think on the wealth management side, you can have a very good cross-border digital offers. There are few fintechs which offer that. If I had known them, as I said, I would have been buying them, not partnering, but buying them to offer a pan-European product. So, but beside wealth management, on the pure retail side, mergers do not work. That I'm very, very convinced.
Yeah, but by the way, it is not only capital and liquidity limitations, but also regulation on data, different mortgage requirements regulations. So if you can't front to back integrate these products, it's currently, there's a stack of paper so high in the Netherlands of the requirements of a mortgage, and the same stack of paper is in Germany, in German, but then completely differently, and the same in Belgium and France or where have you. But and so because that is 90%, and we have tried some of it, to be honest. But in the end, if you want to do cross-border retail banking, it bodes for what we call organizational integration. That means not only, and the balance sheet and the capital and liquidity, that means your IT systems, but it also means product integration. If you can't realize product integration because the products are the same, the benefits will be limited. So when talking about, and that's of course the advantage that the States has, there is one type of mortgage, well, there are of course more mortgages, but there is one regulation around mortgages, there's one regulation around data, and there's one regulation about customer safety, and so forth and so forth. So it's not only capital liquidity, it's the whole stack, because the product integration, the level of product integration you can do, determines how much you can integrate your organizations.
And of course that's problematic, but again, this goes back to the issue. Some would say, if you think about just the European Union as a whole, this is a massive single market. It is clearly the moneymaker, certainly for the Union, but definitely when it comes to this particular sector, it is massively underused. Yeah. So then, again, going back to my question, I asked you this before, but then what changes this dynamic? I know you said you endorsed the message from the European Central Bank, then you mentioned the politics. What's going to change these dynamics? But there needs to be something that you think this is what's required to change this.
Yeah, I don't have, to be honest, I don't know. So I think that it's just, I think that the realization of Europe, and I think we need to be better in that it is for the benefit of the population of Europe that we have a more aligned and harmonized state of European legislation that then in the end will come back to the banking union. I mean, in the end, if you, let's say, have a one deposit and one lending market, clearly it is much more efficient how lending and deposits and savings will clear. That is to the benefit of Europe. And that needs to be seen. And currently that is not sufficiently the case. But perhaps you have a better answer.
No,
Ladies first.
Okay, thank you. No, I think we go back a little bit to the discussion we had yesterday when Jacques de la Rosière and also Anna Botín was talking. And I think here the banking sector itself actually has a bigger role to play, because here I believe in particular European supervisor and banks are actually in the same boat, because they all want a more integrated market and the removal of this impediment. So perhaps the banks themselves can actually play a big push in this direction. And maybe, hopefully, politics and regulation and all these impediments will follow. But it's maybe the banks that have to show how beneficial this integration actually can be. It can be one element that certainly may help.
Yeah, I think nothing will change the dynamic, basically. So it's not going to work. Let's be let's be super clear about it. We are not all going to be speaking Dutch or French or whatever, because you need to have one single market. We say we have one single European market. It's true and it's wrong, because we have, the market in France is different to a market in Germany, to the Netherlands. When you want to issue a mortgage, very different. You're not going to have a convergence of, the local laws, or, all the local specificities or tax, etc., well beyond, the 50 years I mentioned. Okay, so that's not going to work. And let's do that. But there is one thing which can develop. So this is why I think EDIS or whatever, forget about it. But we were speaking about EDIS for so many years. It's not here, it's never going to be here. And I'm making a statement here. But where we can progress is on the capital market side. And on the capital market side, Europe is behind. And it's a real problem for European banks or for European investors. So we need to have a change in the pension fund and in the insurance company's ability to invest in European assets. So the Commission did its work in terms of the prospectus and the regulation. But where are the investors? And the investors are not developing enough, because we are lacking versus the US, the size of the pension fund and the ability of insurance companies to invest. So if there is a priority today, it's not to have a convergence of tax regulation, of employment regulation, of mortgage regulations, aren't going to work, but it's on the capital market side to develop much more investors to fund our retirement, and it's super important for me now to fund the retirement, okay, much more than 10 years ago, and to be able to, access and develop debt and equity capital market to fund growth in Europe. We don't have today in Europe the ability to provide growth capital is ridiculously low. It's growing, but it's super low compared to the US in Asia. Mm-hmm. On the debt side, when Andrea and I discuss in 50 years the digital euro, we need to have more capital market to be able to fund the banks and others. So, the big focus has to be on that.
The Capital Markets Union. And the other point, because again, maybe I should have said this before, there will be questions from the audience at the end, and also if you can send them online. So there's a part, however, that I do want to introduce, because it was mentioned at the start of the session, which had to do with, Stuart, you mentioned financial repression. One of the big topics this year, certainly, that connects, well, everything we've talked about, the politics, the change in monetary policy, the higher rates, has been the pushback that we've seen from a number of governments and jurisdictions this year, with a number of bank tax that have been introduced. I wonder, and this I leave it to you, whether it has been a successful operation or not, and how would you describe this phenomenon that we've seen this year? Because some of these governments, even if it didn't really work in terms of the funding they were able to bring in, still defend it as an idea. They say it was right to do it.
Yeah, so it depends on how you define success. I mean, if success was finding 3 billion euros at 2 minutes to midnight, then I guess it was a success for those governments. But I mean, it has repercussions, and in every investor discussion I have, it comes up. I think on the bank tax side, if you invest in European bank equities or credit, it comes with the territory. Crazy Europeans are going to do crazy things every so often. You kind of expect it from the politicians to some extent. It's disappointing, but it's not totally unexpected. And you can do your homework in terms of which governments have the biggest problems, and therefore it might be the bigger problem. I think the more corrosive issue this year has been the MRR, because you expect politicians to do weird things, but you don't necessarily expect financially literate central bankers to do weird things. And I think that
You're a brave man.
Sorry. But I think on the MRR, I mean, it's not been explained what exactly the purpose of that is. And you can say, okay, it's only a couple of billion euros, and what does that matter? But when you have some central bankers talking about 5 to 10% MRRs, I mean, that is very corrosive, because if you're an investor in America, you don't know if that's consensus view, if that's sort of at the margin of thinking. So I think it just is another factor which adds to the cost of equity of the sector. And I wouldn't overstate it. There's other factors which are very important as well. But you kind of layer these things upon themselves, and it's another reason to not buy European equities and just go and buy JP Morgan, because you're never going to lose your job if you own JP Morgan shares, so why bother?
Can I add one thing here? So maybe it's more a generic point. So in the end, and I think that's important, that it is good for economies if banks can grow and put their money back in the economies, and that also means that you need to have banks that are valued properly and that make good returns, because those good returns will filter back in. It will keep the banks safe. The capital will go up. They can invest, etc. And for investors, and the majority of the, or the majority, 50% of, or the majority of the funds that are invested in European banks comes from the States or comes from American investors. And in the end, what these investors want is predictability and reliability. And things like, in different countries, certain bank taxes, like in the Netherlands, with an outgoing cabinet discussing a budget, and then on one day of the budget, a few people saying, hey, why don't we swap a few billions left, right, and center, including a bank tax that is just, it was not even tried to explain, just no, for budgetary reasons, increase the bank tax, which initially was there. And by the way, in the Netherlands, which is global, not even local, which is even more ridiculous, based on the fact that you want more safety at a time when banks were more dependent on one country, and ING was at that time seemed to be too big to fail. But you just even don't go back to the reasoning of that law anymore and just fill a tax gap. It's just not good. And it's just an example of the reliability, or how investors will look at the reliability and predictability of the European governmental landscapes to see where they will invest. And we need to improve on that.
For sure. Professor?
Just following up on that, actually, if you look at how the tax on the bank profit has been introduced, is actually there is a big heterogeneity across countries. This is really surprising, both in the size of this tax, in the criteria for the application. For example, if you look at Ireland, it only applies to banks that have taken public support in the past. Sometimes it's una tantum, sometimes it's more permanent tax, sometimes it's, so it varies a lot. So this increases also the unpredictability or the difficulty for an American investor to understand, because as he said, ultimately, American investor will look at the European banking sector. I'm not so sure how much they're actually able to distinguish each single country and to make predictions out of all these differences.
And can I just, as a follow-up on this, Stuart, you said it depends on what you mean or how you define success. If 3 billion a minute to midnight is considered success, then it would have been successful. Some of these governments would say those 3 billions to my voters matter, so I think it was successful. It's clear from what you said that you think the damage is bigger than what's actually achieved. But just perhaps on, and to be fair, on a more perhaps intellectual basis, what some of these governments say is that it was subjective, the pass-through was slow, and that them jumping into this fray accelerated this process. Is that fair, or do you think, well, that's a way to excuse maybe what turned out to be a bad market move?
Well, I mean, I think that if you say the rationale for it was the banks were over-earning, I would say the banks are not over-earning. I think the banks went from under-earning and are now back to a level of more normal profitability, and I think to some of the way the bank taxes have been constructed are not set to really get to that answer of are they over-earning, because if you're looking at revenues versus profits and all those kind of things, it creates some odd incentives. So I think if you look at Spain, if the argument was intended to lead Spanish banks to pay more to savers, it seems to have done the opposite. I think Spain has the lowest deposit beta in Europe right now. So you could argue it's just been a wealth transfer from Spanish savers to the Spanish treasury, and the banks have just been the pass-through mechanism. Arguably, if you wanted to reprice deposits, the better way of doing that was as Belgium did it, where you just go out with a very attractive one-year offer and 7% of the deposit base moves overnight.
Which they say they did in response to this. So again, it was a different carrot and stick, but the rationale behind it was similar. Is it a problem with the execution then?
But I guess the point is, investors are not crybabies. They tell us what the rules of the game are, and we can price that risk effectively. It's when the rules of the game keep changing, there will be a knock-on impact in terms of the cost of equity. And if that's the price that you want to pay, fine, just be overt about it. Say, this is what we want to do. This is the ROE the banking sector is allowed to generate. We have a utility. This is the ROE we accept, and anything above that belongs to us, and anything below that belongs to you. But I think it's that lack of knowledge of the rules of the game which leads to that cost of equity being unusually high, partly.
And it is a banking supervision. Before we take it to questions from the audience, I have to ask you, of course, about risks that you see it playing out in the medium to long term, perhaps. Mr. Body, I know you wanted to comment on this specifically, so I'm going to give you...
Yes, so we go back to the third but that I mentioned at the beginning.
Yes.
Actually, it ties in very closely with what we heard, but if you put it in the bigger context, and it's the fact that and we had a special chapter in the annual economic report last year looking at the interaction between monetary and fiscal policy. If you look longer term, I think that the biggest risk to macroeconomic, financial and price stability that we see is the trajectory of government debt. And the fact that initial conditions, and again maybe people are not fully aware of this, were extraordinarily well, let's say unprecedented again by historical standards. If you look across the world, and this is not just particular countries, but across the world, the median level of the government debt to GDP ratio, even before COVID, was already at historical peaks. It was roughly at the same level in line with what we had seen during the Second World War. But of course, interest rates at the time were so low that the debt burden, the interest burden on the debt, had never actually been so light in history. I mean, again, it's rather bizarre that people were, if you like, referring to that period as the new normal. I mean, if anything, it was, if you like, the new abnormal. And of course, now things have changed. And if you look ahead, even with interest rates being below growth rates, and they are not now, the debt trajectory is extremely concerning. And that does not even include the new demands that we are putting on fiscal policy in terms, for example, of the green transition, more defense spending, and of course the aging populations that typically are not taken into account in these numbers. And moreover, what I feel is that following the COVID crisis, which actually led to a further fiscal policy response, the general population has now got used to this strong support from the public sector. So the politics are going to be very much against getting these things under control. And if you look historically, and not least in this part of the world, I mean, the very high debt levels have created problems for financial stability, but also for macroeconomic stability and for inflation. And in a way, even the losses that we saw in the materialization of interest rate risk were largely losses on public sector securities. And moreover, to complicate matters further, the fact that central banks have been buying quite a lot of that debt, at least in some jurisdictions, means that although you may think that that government debt is long maturities, if you consolidate the public sector debt and you consolidate it with the central bank, you will realize, and this again ties back to what we were discussing earlier, that a lot of that debt actually is at overnight rates. It's indexed at overnight rates because of bank reserves. That doesn't show up as higher interest payments for the government, but shows up as lower revenues for the government. And of course, central bank losses, that again creates a problem. So I think that going forward, I think we really have to be watch out very closely, the public sector side of the equation.
Well, thank you for that. And Professor, of course.
Yeah, so if I, as a chair of a risk committee, what I am most worried about, I think is the same as supervisors are also worried about, which is waking up one morning or having anyway sudden disruption somewhere in the system. I think this is what really keeps me awake at night, if you want to ask me that question, if you can say that question. So anything that has to do with geopolitical risk at the moment, for example, which is not related to interest rate, but of course this can be a very sudden disruption. And related to that, a little bit, all the sanction regimes actually become more and more aware of the legal risk that we may be facing. Because banks anyway rely on the rule of law, contracts for certain operations, but in times of wars, maybe the rule of law is not always applied in the way we would predict. And that also can impose substantial losses on banks. So that is what I'm worried most about. So when I have my meetings, what I keep saying is the what-if question. How do we actually manage this potential tail risk? And of course, the banks cannot and probably should not start acting thinking that there may be this tail risk, but they should be ready to act should this risk materialize. So stress testing, I think, is something that we need to put a lot of emphasis on. And it's not necessarily the stress test the EBA, the ECB conduct, but it's the internal stress testing of the banks. So banks do much more stress testing than regulatory stress testing is concerned. So going back to Mr. Barr this morning, liquidity stress testing, assumption in behavioral model of deposits, we know very little about it. So these are what the emphasis that I personally would put right now very highly. So I share very much one of the latest speeches of Andrea when he was saying going forward, this is not just about capital. This is about supervision, being preventive on one side, but more detective and corrective measure. I think there is really what matters the most. And as Mr. Barr was remembering us this morning, it's a matter of Credit Suisse, Silicon Valley Bank. They're not coming out of nothing. They are coming out of a period of weaknesses that have not been solved. So this is, I think, where the focus should be going forward, rather than regulation or increased capital in itself.
Thank you for that. And Jean-Pierre?
No, I fully agree with what Elena said. I think there are well-known risks in the banking sector. You mentioned some as well. I think there are two risks which are new to a certain extent, which is the liquidity risk because of the change of behaviors, and it was very well explained this morning as well. And that's something which is very difficult to model, first of all, and we have models which are changing because of that, basically, because the customers are changing. And we have not mentioned cyber risk, and I'm the chair of an IT company as well, which provides very good cyber services, actually, if you would like to use them. But the cyber side is what was keeping me awake at night, actually. And if the system is blocked for whatever reason, for 1 day a bank can handle, for 2 days it becomes difficult, and for 3 days you don't have any more problem because you don't have the bank anymore. So I think the cyber risk and management or cyber risk on the payment side, it's a payment issue, first of all, is something which has to be looked at is being looked at, but the cyber thieves or criminals are very innovative, and so it is a new risk which has to be looked at very, very carefully.
Well, thank you for that. Unless there's further comments, I will now switch to the audience, and maybe we can take questions from them. So if you have a question, just introduce yourself and put the question.
Thank you very much, Nicolas Veron at Bruegel and Peterson Institute. I cannot resist expanding on what Elena said about referring to Jacques de Larosier's remarks yesterday, which were also taken up by Andrea in remarks yesterday night. The position of the banking industry in terms of the completion of banking union, and I guess Jean-Pierre gave us his opinion already, but my question is to Stuart and Mr. Van Rijswijk. Why is it that large European banks, or at least a critical mass of large European banks, are not pushing more for completion of banking union, given the strategic advantages that appear blindingly obvious to most of us here? Thank you.
We are. We're just not very successful. That's the reality. So I think that for years we have been talking with the European Parliament and the European Commission and with our own political leaders in the countries. There are a number of challenges, which is also in the sovereignty of the countries, people feeling that why should we merge our deposits with those of some other countries, and if then bankruptcy laws in countries differ, what would that mean in terms of my deposits then going to deposits or going to make up for holes that are being put in some other countries. So there is still a big divide between different countries in what they feel who should pay the bill if something goes wrong. And at least, let me speak for myself, I have not been sufficiently successful to change that opinion.
I think from my perception, I think the industry is split. I think some CEOs see value in it, some CEOs don't. And the counterfactual of just buying back your stock, it's a no-brainer. I mean, if you have to explain to a skeptical investor why you're doing a cross-border deal which you know they won't like, versus just buying back your shares where there's zero execution risk, that's a very high hurdle. And for you to be able to surmount that hurdle, you need, I think, some sort of narrative shift to say this is why it now makes sense. The obvious narrative shift, whether it would be real or not, but in terms of giving you that air cover, would be EDIS. I agree with Jean-Pierre, that's never going to happen. Yeah. So from that perspective, kind of, I think the industry finds itself somewhat hamstrung. Now, I take the point, the industry could be the leader and could make the case to the politicians as to why EDIS should happen, but I think if you secretly polled CEOs of European banks, I think you get a split jury on whether they actually believe that or not. Maybe I'm wrong.
And I heard someone here, and I think it was you, Irene, who said, but why? Do you want to, so maybe you want to...
Actually, I wish we could integrate the two panels. I'm speaking afterwards. Yeah, sorry. No, I mean, it's an instinct. You said, yeah, it is never going to happen. And this is exactly the attitude. Why it's not happening? Because it's everybody is so giving up on this. And I can assure you that's not true, because what we've seen in these past 5 years in the Parliament and in the European Union is that we are capable of doing things that were not imaginable even few months earlier. So when there is the political will, and by political will is not only the will of some politicians, the political will and the political power rests in all the actors. And the banking sector has a much bigger political power than they are wishing to admit. The issue is that how do you spend your political power? So I've met quite a few of you in these years, and I know how passionate you can be when you have to advocate something. So it's just that you have to direct your passion and your energy towards something that is also long-term, strategic, and that help us, because us in Parliament and in the Commission, you've acknowledged that, we do everything we can to try to push on these projects. They think that, I don't want to point fingers, I don't want to do name, shame, and blah, 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 but you know what I'm referring and who I'm referring to, and where you have to direct your passionate advocacy for a more integrated banking sector. So honestly, when you say it's not going to happen, it is going to happen if you help us, if we can all work together, because we've done things that were unimaginable, and if you look back, you know that we've done that. Sorry.
Aidan, thank you so much. No, forgive me for... But I heard you go why, so I thought I had to.
Just thank you very much for this passionate plead for EDIS. Let's assume it happens. I don't think it's going to change anything about bank merger and integration and creating, pan-European champion, because there's no rationale and there's no synergy on the retail banking side between different countries. So we can say whatever we want to say, it's not going to work. And that, I have a very high level of certainty that is, it might help, but not very much, and there are other things that bankers should do. Wow. What is super important is to work on the capital market union, not on what the Commission has been doing, but on making sure that we can have more investors to buy European shares and European debt. This is what is putting us back versus the US side. You mentioned that the largest part of shareholders of European banks, like on many European shares, are non-European. And that's a problem for economies which are the same size, basically. So, if we had to do something important for Europe to promote growth, to fund companies on the equity side, on the gross equity side, on the debt side, it's much more on the investor side that we need to focus.
She will be back for the next panel, so I think maybe we give the mic, but after. Are there any more questions from the audience? This is the final one that we're going to be able to take because we're running out of time. So yes.
Hi, thanks. Giovanni Bassani from the ECB. Mr. Mustier, you're really very pessimist. I mean, if you wait for everybody speaking the same language, I think that's really never going to happen. To Mr. Van Rijswijk, there is one issue that I've always been curious about. Why do we have JP Morgan, Societas Europea, Morgan Stanley, Societas Europea, but you don't transform yourself in a Societas Europea, and so all this problem, at least, of fragmentation and compartmentalization of capital and liquidity would disappear. So we need to have, I would say, ING Societas Europea, like we have Goldman Sachs Societas Europea, Unicredit Societas Europea. Why that does not happen? Yeah. At least it will be a first step, and you can do it without any legislative changes of treaty changes whatsoever. Thank you.
It's a good point, because I was almost going to say in the whole EDIS discussion, thank you, by the way, for your passion. I shared it, by the way. Is that indeed the fact that if we would move the flag 150 kilometers eastbound from Amsterdam to somewhere in Germany, Gelsenkirchen, for all I care, we just put it there, then that changes my macroprudential buffers. That's just, and nothing changed. So why are we doing this to each other? But that's just one element of it. On this Association European, that is a possibility. But if you already have activities in different markets with subs, that you cannot suddenly, but this is going to become a very technical and legal story, transform just in a European association like the American banks have done. For new activities, by the way, this is a very good one. So it can help to some extent, but it will not take away everything that we just talked about.
Well, thank you for that. We have reached the end of the session, but before we leave, Mr. Enria, there's a message for you, and it's Jean-Pierre Moustier who's going to deliver it. I think this is going to be more optimistic about something that will happen.
Well, I am optimistic for the banking sectors, but not only this, but that's another story. Let's not go back to that. There's another panel. Andrea, I was tasked by the panel to say thank you. And I would like to say thank you, not only on behalf of the panel, but also for the years where we worked together when I was at the European Banking Federation, and specifically the few months where we were in lockdown and we were discussing, stopping the dividends, and we had this, very close interaction, and I discovered the human being behind the regulator, basically. And I think that we owe you immense thanks for what you have been doing for the banking sector. And when I'm saying immense, is the future generation will see and will realize what you've been doing, which is unbelievably good. So thank you very much for that. And when I'm here and speaking to all your team members, the respect they have, but more importantly, the pride that we see with all the members of the ESM to be working at the ESM speaks a lot for what you have achieved. And I think you did something absolutely extraordinary. And so thank you very much for that. And I would like to, of course, pass our best wishes to your successor and wish her, best success as well for, very interesting days of EDIS, digital banking, fintech, and others, that we are going to see. So good luck to you, and thank you very much to Andrea. Thank you.
Well, on that note.
Thank you very much. Thank you very much, panelists, and thank you very much, Maria, for moderating. I mean, very lively panel. We're a little bit over time. We will still give you the coffee break, but let's try to get back at 11:15, if you may, and thank you again. It's very great. Hello, welcome back from the break. We know you like the networking opportunities, and there will be a little bit more later on. So, but bear with us. We're going from the last panel discussion straight into this panel discussion, which is very similar, and we hope this panel will tell us what the future will bring, of course. The panel is entitled "The Road Ahead for Bankers and Policymakers." Let me introduce the moderator, Patrick Jenkins, Deputy Editor of the Financial Times, and Patrick will introduce the panelists. Over to you.
Thank you, Connie. Well, thank you for the opportunity to be here. It's great to see so many familiar faces. Very pleased to have the panel that we've got here, a great mix of revered figures from across banking and politics and regulation. On the far side, we have Frank Ellison, the Vice Chair of the Supervisory Board at the European Central Bank. Next to him, we have Thomas Serenheimer, Chairman of the Economic and Financial Committee of the Council of the European Union. Christian Sewing is CEO of Deutsche Bank and also President of the European Banking Federation. Irena Tinali is Chair of the Committee on Economic and Monetary Affairs of the European Parliament, and Sam Woods, Deputy Governor for Prudential Regulation at the Bank of England. Thank you all very much for being here. As Connie said, the theme for this panel is what the future holds, the road ahead, both from a banking and policy-making point of view. So there's a broad spread of things that we could and should talk about. I want to pick up on a few of the themes that were touched on, perhaps in a bit more detail from the previous panel, and maybe start off with this valuation point, because I do think it's crucial for European banks. I was talking to a consultant the other day who pointed out that 85% of Europe's banks are now trading below book value. And the vast majority of those have been trading below book value for a decade. In any other sector, these banks would no longer exist. These companies would have been wound down, broken up. They don't make economic sense. But clearly, there are other factors at play here. Christian, you've been running Deutsche Bank, and in the majority, in having a valuation that's below book value. Tell us your kind of perspective on why this is the case, and if there's a glimmer of hope for it changing.
Well, first of all, thank you for the invite, and yes, we also still exist, and we will exist, so not to put any concerns or doubts here. Look, I think this has various reasons, but also, you said glimmer of hope. First of all, coming from the lows, clearly, but if you look at the valuation of European banks this year, also compared to other industries and also to other regions, you see that there is a slight turnaround. Nobody of us can happy with that, and it's not good enough. And you know, Andrea on this wonderful dinner last night also said it. We cannot be happy with that. But you know, we always need to look at the full story. And coming from a time actually with zero or negative interest rates, with clearly some banks, and you know, Deutsche Bank was part of that, not cleaning up early enough and being in a complex situation. That explains a little bit the past valuation. Now, why is it still so, and how do we get out? First of all, I do believe, and I was unfortunately not part of the previous panel, but in such a scenario where we are living, in particular in Europe, investors don't like, just by category, levered industries. And banks are more levered than others, and there is always, obviously, a little bit of reluctance, which we have to take into account. Secondly, I do believe that there is still a lot of concern about the economic outlook for 2024. If you read all kind of forecasts now for the year 2024, most of the analysts are actually saying, and researchers, that they see a slight recession coming. And obviously there are then doubts, what does it mean to the asset quality of the banks? And not potentially only for commercial real estate, but also for other asset classes. Number three, the analysts are saying And on the other hand, over 2024, interest will come down, so the good ride on NII is coming to an end. So how is the business plan and how is the business model adjusting to that? And I think these three items are all kind of blockers, so to say, that we as banks with our business model have to convince the analysts that despite this situation, we are actually in a position to further increase profitability and keep the momentum which we have seen in 2023. And not in order to take most of the time here on the first question, but I can see exactly that. Because if you really look at the world, and if I look at what Deutsche Bank can do about it, there are the geopolitical conflicts. We have the mega task, but also opportunity of transformation, and we have AI. And I have never seen more client demand than we see currently in terms of advice, in terms of future financing needs, in terms of risk management of corporates. And therefore, the role of banks in advising corporates, private clients, with regard to the challenges which are out there, is getting bigger and bigger. So therefore, I can see where the concerns are, but I think with the solidity and the robustness we all have achieved in European banking, when I look at the balance sheets, at the capital and liquidity position, at the asset quality, the, in my view, repaired business model, now with the need of the clients actually to ask for advice, I think actually that the momentum which we see on the top line will go ahead. And if we keep the discipline, and that's what I see across Europe actually, on keeping costs under control and having solid underwriting criteria, then I do believe valuations will come up more and more, and therefore I'm not concerned, but we need patience. Last but not least, one item, and I put it actually really at the last, because I hate to always finger point to other items, but there is also uncertainty about European regulation. Whether when banks are earning more money, it's windfall tax, or we have a discussion about minimum liquidity reserves, all that is holding some investors back and saying, we saw the dividend decision, and I'm not criticizing that, in 21, is something like that coming back if banks are earning again more next year? That is a force point which we should not completely lose.
Lots to pick up on there. Before I move on to other panelists, I just wanted to pick up with you, Christian, on this point of kind of fundamental performance of the bank's loan book and deposit base. There's this perception that the NII has peaked or is peaking, that presumably we're close to that, regardless of whether we're at that point yet. But what about on the loss expectations? Because there does seem to be a distrust, and I think Stuart Graham in the last panel pointed this out, the distrust from investors that the kind of benign loss expectations that a lot of the banks have just not believed by the investment community. How can you convince them?
Well, by quarterly delivery of our numbers and sticking to our targets. I think you can only convince investors if you say something and you stick to that. That's what I'm always telling my management board. If we give out a cost number or a loan loss provision guidance, it is really vital for us to stick to it, or if we are outside that we have a good explanation. Now, on the asset quality, I do believe that we see a slight deterioration in asset quality going forward, because at some point in time, the higher interest rates will have their impact. I mean, you can't negate that. But I do also think that banks have done a far better job. And I've been Chief Credit Officer of Deutsche Bank 15 years ago. If I compare now the underwriting standards, the way we manage concentration risks, the way we are trying to diversify our portfolio, this is of a different quality than before. That's number one. Number two, never forget that this crisis, not crisis, I retract that, this challenging situations which we have right now is different than before. The last time that Deutsche Bank in 2002 and 2003 had very high loan loss provisions was actually when the unemployment rate in Germany was a completely different one. We don't see any difference in the book of mortgaging, in the consumer finance book, because we have high employed people. Now, if that changes, then obviously you come to a slight deterioration, But I would say this is a different picture than in previous cycles, and therefore I'm more confident than previously that we can run this with normal loss expectations.
Okay. Frank, let me pick up with you on one of the points that Christian made there around the predictability, if you like, the stability of the regulatory and tax environment that he mentioned as well. And that this seems to play a role for investors, particularly, I mean, it's true globally, I guess. Rules have been changing steadily over the years, and we heard earlier that, you know, maybe there needs to be further changes to the liquidity regime and so on. But can you reassure investors that basically there's going to be a stable environment in terms of the rules?
Well, first of all, thanks also for having me here on the panel. I thought this was a panel on the future, and if you ask for some reassurance that everything is going to be stable and not change in the years and decades to come, I'm going to be disappointing you more generally. I guess later we will talk maybe also about climate, and you will see that things are not stable at all. But maybe to react briefly, but because I think lots have been said already, also in the other panel, yes, on valuations. But I think it's fair to say also from our part as a regulator that of course the banks, when you take a little bit a longer view and you think back to the great financial crisis, how we came out of the great financial crisis, banks of course are now in a much better state. Banks are resilient. Banks are well capitalized. We have heard the high liquidity ratios also last night mentioned by the president. This morning it was mentioned. So we should not forget that. To start off with. It's also true, all of us know, of course, because of the unprecedented rate hikes that we have seen, that the NII has been what it has been. But of course, we are supervisors, so we worry. We are paid to worry. Yesterday, Sean Bergen said that he was paid to be optimistic. So we do look at asset quality. We do look at credit risk. We do wonder, just like you said, Christian, whether these higher interest rates will in the end lead to a higher cost of risk. So, but all in all, I think that the starting point is what I said in the beginning. The banks are resilient. And we should not forget that in that story.
Sam, just to pick up on a kind of similar question, can investors, or banks and their investors, look forward to a stable period of rules?
So thanks, Patrick. Look, many investors here, you can speak for yourselves, but I think Christian covered the main points. I thought Stuart also captured it well. Essentially, it comes down to a concern that current levels of profitability will not be sustained. I noticed that Stuart also said, effectively, that he thinks the share prices are wrong, and we should attach some weight to that given the quality of Autonomous's work, but also because Stuart is exiting the stage, as far as I know, does not have a financial interest in making that pitch to you all. So I think we should note that. On the last of the factors, and I'm glad actually, Christian, you put it last, probably partly be polite, but when I talk to investors, it does tend to come up last, but it is relevant. Maybe I don't disagree with what Frank said, but I would just put it slightly differently in that I think people need to take one pace back. There's a fear, an active fear, I think, amongst investors in bank stocks or those who might invest but are not currently investing, that the prudential regulators in Europe described broadly to include the UK, want to gobble up all the capital that there is in the banks and that they'll never see their part of the bargain. That is just flat wrong, to be honest, and I'll tell you why it is. It's for two reasons. One is that the really big capital rebuild that happens in this financial crisis, the big part of that is done. Now we've got Basel III coming through, but on any implementation of that is a relatively small thing compared to what we did in the last 10 years. And I think people have lost a bit of perspective about that debate and the relative size of any changes that will come through in any implementation of that package compared to what we did in the last 10 years. I think that point is a bit missed. Secondly, that is prudential supervisors, it's not our job to define the business models of banks or to be chasing their profitability. That would be very odd. But we have an interest in banks being able to earn a decent return for the obvious reasons that helps command confidence in the business model and makes it easier for them to generate their own capital. So it's not a one-sided thing. I think investors sometimes think there's the regulator bit and they gobble all that, and there's our bit. Actually, it's not quite like that. The investors should know that we have an interest in bank stocks being investable. So I do actually think that the really big reform period on bank capital is done. Nothing's ever static, as Frank says, and of course there are also new things. But I'm not anticipating that level of reform, it just simply will not carry on at the same pace it's been for the last 10 years.
Yes. Well, I'm sure that'll be a great relief to many people. But what about another aspect of things that are holding back European banks? I think it was touched on again in the previous panel very briefly, the scale of banks here. If you go back to pre-2008, the biggest European banks were kind of the same size as the big American banks, and now the kind of factor of 10 differential. One of the things that could obviously help change that is if the European market became more of a single market. And I just wondered, Thomas, if you wanted to address that point of how, again, kind of banking union and single deposit scheme and so on are vexed topics. People, a lot of pessimism about whether there can be any progress here. But you're a believer. Is that fair?
Well, thanks, Patrick. So Sean Berrigan is paid to be optimistic. Frank is paid to worry. I'm not paid to be anything particular at all, so I'm just going to tell you how I see the banking union, and if you allow me, I'll say a few words about the capital markets union, and so go. So starting with the banking union, so it's been said by many over these 2 days that we've actually made remarkable progress with the banking union, and Andrea is a living proof of that, and as is the relative stability that we've seen around us over the last few years, and that is something to behold. But on the other hand, it's also, there's a flip side to that coin, and that is that the existential pressure that gets on the political momentum has more or less run its course. So there is very little political capital invested nowadays to do anything that is difficult to sell domestically. This is the challenge we are facing. We did not let a good crisis to go waste, definitely not, but that's behind us, and that's a pity, and that's much of the reason why the CMDI is making so painful little slow progress in the legislative work. I hope it nevertheless makes it over the finish line. Everything else is more or less in abeyance right now, waiting for that file to come out at the other end. But then there is one part of the work ahead of us that I need to emphasize. I think we need to push ahead with, whether there's political momentum or not, and that is the issue of liquidity, which has popped up so many times during these 2 days. And I mean, when the BRRD was negotiated almost exactly 10 years ago, I mean that was when the big push was ongoing. That debate was framed in the context of what has just happened in the global financial crisis, and the model of bank failures that we had seen. And I mean, even though at that point people did realize there was a liquidity aspect to things, the idea that there would be a bank that fails purely because of liquidity issues was considered kind of nice theoretical, but completely unrealistic prospect. So the outcome was a legislation that didn't really differentiate between liquidity and solvency. And the outcome of so the result of this we are seeing right now. We clearly don't have the machinery to respond the way, the American authorities responded this spring, or the Swiss authorities. I don't see the Swiss authorities right now, but anyway, this sort of triangle between central bank, fiscal authorities, and regulators, we don't have a structure for that to work. We need to do more on that and try to create more predictable framework to act quickly. That is something I would put as a first order item. I move on to capital markets, which is quite a different kind of story. There's endless political love towards that project. There's not a single politician who doesn't declare devotion to the capital markets union. Now, 8 years since we started working on it. I think there's a bit of a cynical view on it. I think we've made more progress than we care to admit, but clearly we are still at the start of the project. The problem here is that we kind of keep misrepresenting it, misframing the whole issue. Many times it's thought, and I'm not talking about you guys, I'm talking about the political circles. It's thought in the same mind frame as say the single market, goods and services in the 80s, that it's just about removing a few regulatory barriers, opening the floodgates, and the demand will be there. That's not really what the issue is. We have capital movement is free. It's just the question is that there are all kinds of little complexities and annoyances, lack of, starting with the fact that many European countries don't have anything that you could call capital markets. So what do you integrate then? But it's a very complex project of little things to nurture the sort of culture. In the previous panel, it was mentioned that we need to work on the investor side, which is very much true, but it's not a small ask to create pension funds in place of the primarily Pillar 1 pay-as-you-go systems we have. It's a fundamental change in societal structures, which is kind of something that characterizes all the big-ticket items that we can think of. It's the pension system, the taxation, insolvency. All these create kind of obstacles to capital markets union, but these are not things that have been set in place with capital markets in mind. They are not protectionist things. They are deep societal structures. And yes, we can work on them, but don't expect quick revolutions. So I'm finishing here. My sort of point here is that we are making progress with capital markets union, but it's not going to, and we need political pressure, we need commitment, but don't expect the future to look considerably different from the past in that respect. It's going to remain a grind. It's going to be a very fragmented effort working on many different files, but it's moving, and I'm quite convinced that we will be making progress over the coming years.
Irena, thank you for that. Irena, you made a passionate intervention in the last panel in support of banking union, and I guess maybe CMU as well, is something you believe in. Are these the keys to enlarging the potential for European banking, do you think?
I do believe so. And
And I wish we could have a conversation with Mr. Moustier on that, because really the fact that I do see the advantages, I do see the opportunities in terms of, as Professor Carletti said, attracting investors that would be much more reassured about a real single market with clear rules, with a more stable environment, less fragmented one. I also do see the synergies. I mean, it's not true that there are two differences. The single market will help smoothing out the differences. I mean, in the United States, it's not that there are not the differences. I don't think that Alabama's market is the same as Massachusetts' market in terms of mortgages or, whatever you want to see. So I do see the differences. I do see the challenges. But I see also these as an opportunity to smooth out the differences, to manage those differences in a way that is more favorable to increase the attractiveness of the sector, to attract the investors. And also, these kind of synergies, they emerge. They're not given and set in stones. They can emerge, they can be built by good strategic management. They are created by technologies. New technologies are actually creating tons of new opportunities for synergies across the European Union. I mean, look at what happened. We complain about the fintech. What did they do? They did this. They saw opportunities to scale up things, maybe leveraging smaller markets at the local national level, markets that were considered low-value things or marginal things at the national level, but they managed to find a way to create a scale-up and going cross-border and then create an opportunity for changing and revolutionize the industries. I mean, markets are changing, technologies are changing, and in this respect, if I may, yes, it's true that we may not expect big revolutions in terms of regulatory or rules or, capital markets, because we know how difficult it is, the political. So it might be slow and no revolutionary. But this is one part. I mean, there is a whole real world outside our regulatory environment, which will go ahead anyway, no matter what. And revolutions may happen everywhere, are happening. They are happening in digital, they are happening in climate, they are happening. I mean, whether we like it or not. And so I think that's our job, is also to use the tools that we have available, that we can build together, to make sure that we are prepared for these changes and we don't always come when it's too late. And on this regard, if I may, just go back a little bit to your first questions about having stable rules. You said we need stable rules, stable regulations. So as a policymaker, I feel a lot about this. And of course, it's important to have, but more than stable rules, what I would advocate for is more predictable and democratically discussed rules, in the sense that, not stable in the sense that you don't change them, but in the sense that you change them in a way that involves all the actors, that is capable of seeing the problems that we want to address with the rules and work together, because we also have to agree what rules are for.
So the way the bank tax, for example, happened in Italy would be the opposite of the way you would like to see it.
I agree.
Even if there was going to be a tax, it needs to be discussed and not sprung on people at 7 o'clock on a Friday night.
That's exactly what I meant. Just to give an example, but it's not the only one.
No.
So, so that does not mean that it's forbidden to think about a tool like that.
Sure.
It may well become a possible tool, but we discuss together what are the tools, which directions, which are the objectives.
Yes.
Is it sustainable? What are the impacts? This is, I think, the principle. And but we have to agree what rules are for. So rules are something that only comes later to repair what is broken, or it's something that allow us to prevent problems and to accompany change in a way that when it comes about, it's not so disruptive and we are prepared.
It's a really good point. So Frank and Christian both wanted to come on.
Thank you. This is a panel about the future. And sometimes I have a feeling that we are making ourselves too small. that we forget. And yesterday we had, you know, a inspiring figure of a former generation who is still now teaching us. There were people that created the single market. There were people that created the single euro. There were people that created the single supervisory mechanism. They stood up and they did something that many people in these audiences then said would never work, would never come about. And if it came, would certainly fail. It didn't fail. Here it is, the single supervisory mechanism, the single currency, the single market. Many of these steps that we Europeans have taken over the many decades were taken because we looked back and we said that disaster we should avoid forever. Can we for once do the right things and the big things looking forward, which is the theme of this panel, and say we need to do a couple of things to avoid something? Our president has given many speeches, I guess also in this room, where he says, you know, and then I stop here, but for now. We need the capital markets union for many reasons, but we can never do the green transition without the capital markets union. We throw this number at each other, and you know, it's so big that nobody, but you know, every year today we need 500 billion plus additional investment for the green transition. We are not even close to that.
Yeah, that's a good point. We should.
And so we need to convince ourselves that we need to go back to that spirit of doing grand things in a grand way, or we will be facing a very, very dire future.
Christian, I'm guessing you would agree with that.
Yes, and Frank took half of my comment because I really wanted to make clear we will never, ever make the Green Deal without the Capital Markets Union. Impossible. It's a 500 billion. Think about how long Germany, I'm not talking about the 60 billion, how long Germany debated about the extra budget of 100 billion for defense 18 months ago. We need 500 billion a year until the 2045 to be financed. It cannot be done via balance sheets of the banks, cannot be done by state budgets, so we need that. What I'm missing in this discussion, and I agree, by the way, it will most likely take some years. I'm not a politician, I'm not an expert at that, but this is a base case expectation. There are items we can do in the interim. There are proposals on the table on securitizations. That would already help to free up the balance sheets of the banks, and we have now, these days, in my view, again, a completely different risk underwriting than we had in 2008. We did a lot of things wrong, and I think we learned our lesson. But let's make sure that also on securitizations, we now walk the next steps. And this is what we need to do, and says, what can we do in order to take the bridging steps to Capital Markets Union in order to free up balance sheet to finance this transformation? Last point, I think we banks need to do a better job. I really do believe that the people out there, if you leave this building and you go down into the Frankfurt street and you ask people about the Capital Markets Union, 50% of the people don't know what it is. Secondly, the other 50% are may thinking this is just in order to boost profits for the banks, increase the variable comp, or pay dividends. At the end of the day, we haven't done a good job, and it starts with us in the bank. I'm talking about this in the EBF, that we need to explain that at the end of the day, it's nothing else than the economic booster for the European Union and for our corporates. And we need to do a better job to explain to the society why this is necessary. And I think if we get this done, it will be far easier also for the politicians in the parliament to agree on the one or the other steps. And therefore I'm thinking it's a joint task. And we as EBF and single banks need to do a better job in order to explain why this is so essential for the European Union.
That's an extremely important point. I just wanted to change. Please, if you want to finish off on this.
Right. So just to touch upon what Frank said, I don't think capital markets union is one of those cases where there are naysayers and then there's a political will that overcomes that. I mean, there's no one who says that capital markets union cannot work or it shouldn't happen, it cannot be done. That's not really the point. The point is that it's quite difficult to figure out what are the bits and pieces that need to be done. Securitization, I think that's probably one where there is, I wouldn't call it agreement, but sort of a clearest interest, a clearest sort of qualitative understanding that there are things to be done. If you then go to insolvency, which it is a big issue in terms of the difficulties in changing it because it links with property rights and company laws and things like that. But when you start to dig up what is it exactly that you need to do there, and what would be the effect on capital markets union, it's not that easy to say. Irene pointed out that insolvency law is not harmonized in the United States. Still, there is a capital markets union. So there is a sort of, in every field, there are sort of lack of analytical clarity of what actually needs to be done. We have this general understanding that it would be helpful if we do this, but in terms of coming up with a good plan of where the bang for the buck is good, is actually quite difficult. But I do agree with Irene fully that the world is going on while we speak here, and that actually may create channels for creating capital markets union outside of the efforts that we are doing here, and I hope it keeps happening.
Okay, that's been a really important discussion about the kind of scaling of the market, if you like. I wanted to change tack and bring Sam in on something that Michael Barr raised in his address earlier, which was the liquidity regime. And a couple of you have mentioned liquidity rules as they stand now. How much do you think the liquidity rules need to change in order to guard against a repeat of the types of events we saw in the US regional banks and also at Credit Suisse?
Thanks, Patrick. Look, the starting point is that the rules that we set have never been designed to prevent a total run from bringing down a bank. And I think Michael was making that point too. I think it was 85% Silicon Valley's deposits went out in 2 days. We're never going to calibrate the regime there. That would be tantamount to moving to narrow banking. So it's about what's a reasonable amount of kind of self-insurance to have in the system. And then I think the second piece, where I'm very much in the same place as Michael, is about how disciplined are we about making sure that in addition to that, banks are in a position to draw down quickly on central bank facilities when needed. Because there are good reasons to doubt, as Michael was saying, that the speed with which even quite high quality assets can be monetized in the market by a bank that's obviously in trouble, that those assumptions are quite right. So I think we need to bring together the sort of central banking pre-position piece with the regulatory LCR piece and have a more disciplined view across the two of them. Now, we've always pushed banks on this in supervision at the PRA, but I would say that the join between those two things has not been as strong as it should be. And some of that's because of sort of technical issues like the fact that some of what is in the HQLA bucket will sometimes be part of what's pre-position collateral. It's just a bit tricky for people to work out. So I think there's a job to do to look at, does the LCR need any recalibration in view of what we learned? That's a good question to ask. But in addition to that, how do we make the pre-position side work better? And if I might just add one other point, if we want to come back to this, Patrick, but it's interesting because at the other end of the pipe, we're going into an environment where the quantity of bank reserves in all of the main systems will be reducing. And that, of course, is the most liquid asset that we have. And from a supervisor's point of view, reserves are nice because it cuts through all of these issues. But there's going to be something about sort of coming up from the bottom, what do we need in terms of your first question. At the same time, we're coming down from the top in terms of the volume of reserves there is in the system. Somewhere between those two things, there's going to be a meeting point.
So that addresses Stuart's point that he said again. Investors complain about the minimum reserve requirement rules in this part of the world. Well, you're saying it's kind of merited, really.
I mean, the record should show that Sam Woods did not offer any comment whatsoever on the business of the ECB, and particularly the MRR.
However,
I think it's going to be an important discussion in all the major jurisdictions over the next year or two about, as QT comes through, and there are also some local funding schemes being withdrawn. For instance, we have one in the UK called TFSME. That's going to be quite a big change in funding conditions for banks at the same time as we're thinking about your first question. And I think we can navigate that, but it's complex.
Okay. Christian, I just wanted to bring you in on this point about, LCR being self-insurance, essentially. Normally, self-insurance programs are designed by, or at least thought about by the people who are doing the self-insurance, as well as by maybe the supervisory authorities. In running your bank sensibly, what do you think is the right kind of, the 30-day kind of time frame that the LCR demands versus the 2 days that Silicon Valley Bank kind of blew up in? What's the right kind of time frame to be thinking about in the modern world?
To be honest, let me start a little bit different. That's because everybody in the room knows that we were attacked at the end of March, and we had a 2 or 3 day event. And therefore, I really do believe that overall the liquidity rules which we have employed, in particular also here in Europe, because I can best judge on those, are, to be honest, the right ones. Okay. And I have to say, we have often different views, but I think the reaction of the ECB to the situation which we have seen on the regional banks in the US or with Credit Suisse in Switzerland, I really have to praise you, because there was no knee-jerk reaction. And I think what is very important is that the regulator, at the end of the day, is looking at the individual banks. Because if you really look at our situation end of March, at the end of the day, we started with approximately 620 billion of deposits. We went down to 595 billion. Now, don't quote me on the last billion, but we went down. The real deposits which we lost through these 7 or 8 days were approximately 10 to 12 billion from wealth management and multinational clients actually in Asia. The most sticky part was the retail and mid-cap and small business deposits, which are approximately in our bank 450 billion in Germany and in Europe. And I think that the most important is, if you think about LCR, it's not only about the ratio, and of course we have to comply with it, and I think we have overall the right ratios, but is that the regulator and the banks in such a situation understand the individual situation of a bank and can say how sticky or not sticky deposits are. And therefore, I'm always saying, when it comes to the crisis in March, if you have these 4 things right, adequate capital level, adequate liquidity measured by LCR or absolute amount of liquidity, but in particular that link to a broad and diversified deposit base, and then you are sustainable profitable, then you can address that challenge. And in this regard, I think it's more an individual assessment of the regulator to the bank in which shape it is there. And in this regard, I have to say, I wouldn't call for action, and I have to applaud, because there was no knee-jerk reaction, and I have to say, we bankers were nervous that this is coming.
Yes. If anybody else wants to come in on this point of liquidity, then yeah, please.
Yeah, maybe just to point what Sam already started, that LCR is probably not the answer to the kind of situations that we're faced in the spring. That comes to the issue of lender of last resort, and what I tried to spell out in my opening remarks, that we need to design a system where it's clear where the central bank responsibilities end and the resolution authority responsibilities start, and then on the way back where the central bank responsibilities resume after the resolution, and we don't really have that a proper framework for that in place, and I think we need to do some work on that.
Okay, that's a good point, Frank.
What I would like to add to this part of the discussion is that, of course, when something goes wrong, and by the way, I think that the European banks, sailed well through the March turmoil. But the immediate reaction many times is to ask, so do we need new regulation, different rules, etc.? But I think a main lesson that we can draw, and you can see this in, I think, an excellent SVB report that was done in the US. You can see that in the evaluation of the events in Switzerland, is supervision. And today we are here also to talk about 5 years of Andrea's chairmanship of the SSM, and I think if you look at these various reports, and by the way, also, although this was completely unrelated to any kind of crisis, but the vice president's report that you asked for and that we got, the lessons that I think can be drawn there is that in a world that is changing faster, we cannot be complacent as supervisors and as banks, by the way. We need to become better at remedying findings. If we see something that is just not okay, it cannot just sit there and year after year, we embellish our analysis and we share with the banks that we are still concerned, and their time goes on. We need to have a culture of effectiveness, of impact, of supervision that maybe doesn't go like this, but maybe goes like this. Things need to be remedied because the world is changing fast. So one of the lessons that we draw from this, and again, this was something we had already put in motion, so maybe I should more say that we were reconfirmed in the road that we had already embraced, is that we had a very close look again to all the instruments that the legislator has given us. I mean, there's a whole list of things that we can do that go beyond, capital requirements. We can set deadlines. We can restrict businesses. We can set deadlines and say if by that deadline you haven't done so, there is actually a periodic penalty payment. So we have looked again at our full toolkit, and we have looked each other in the eyes in the supervisory board and said we are going to be using this. Of course, and this is the lawyer speaking, in a proportional way. We will always prefer to have a real conversation and to convince a bank of the right way to go if we feel that there is a certain risk that need to be remedied. But if then things don't change for the better, we will be scaling up. And I think this is one of the clear learnings of the recent past.
I want to move on and talk about a subject that is that goes beyond banking. That is probably the thing that corporates around the world are the most excited about, and maybe authorities are the most fearful of: AI. Irena, I wonder if maybe I could start with you. From your point of view, do you see AI as a great opportunity or as a great threat?
It's both.
For banks.
It's both. I mean, it is a great opportunity. Of course, there can be also a threat depending on how you face it, how you prepare for it, it's like all new, as I was saying, sometimes from time to time you have these revolutionary changes. And you can't just avoid it. I mean,
so as a legislator, how do you kind of
deal with that? The debate is still ongoing. So we are, as always, when you have to regulate something, to legislate on something that is new, you have to be very careful in trying to not overdo it. So we tend to always have a sort of a gradual approach, like we did with MiCA, for example. So we try to do it on with respect to cryptos and everything. So you have to be prepared to start laying the ground and give also the time to adapt to these changes, to capture the opportunities, but at the same time trying to neutralize the threats. The thing is that, in my opinion, with AI, but the same with cryptos, the same with all these innovations, we need to work together, I believe, in a way, being very realistic and very pragmatic about what is going to happen, and not in a defensive way, which is sometimes I've seen as an approach. Politicians sometimes are defensive because they want to show their strength and over-regulate to tell their constituency they have everything under control. The industry sometimes is defensive in saying we need to block this innovation, or we need to protect ourselves. If you don't do this, we will be destroyed. So if we start...
And when we're competing with the US and China, let's say, in this particular area, do you think this is a particularly European problem, that we worry here about what could go wrong before we worry about what could go right?
No, I think that, I don't want to judge what others are doing. I'm saying that, for example, we saw in the spring that our concerns and the system that we have built made us more resilient, and allowed our banks to be resilient and to our citizens to be protected. So I think we also have to acknowledge that, and we have some specificities, and we are trying to do that. Actually, I see in many fields where we moved earlier, that other constituencies, they are looking at us, actually, and we are setting standards. And frankly, I prefer being a standard setter rather than to passively be the one that run after what others are building. So we do it gradually. 2 years ago or last year, when we had this mission in DC, and many of our colleagues in the Congress were very interested in what we had managed to do with MiCA, for instance. Yeah. So we had a lot of interesting debates and discussions, and I think that was a good first step. It's gradual. Of course, we have lots of people that complain that's not enough, for someone it's too much. But this is, of course, always the risk of what we do. But I think that by moving together, so regulators, policymakers, and industry, identifying what are the trends, what are we going for, and trying to anticipate both the threats and the opportunities, we can give ourselves a better environment to embrace the change and not be threatened, to neutralize the threats and take the opportunities. But we need also to lower our instinctively defensive approach.
Yeah, and Sam, do you?
Well, yeah, I'm glad to hear Irena's tone, which I think is very sensible. Obviously, the development of generative AI is a massive breakthrough, and unusually, of course, it has one manifestation with the large language models where we can all immediately feel how big a breakthrough it is. I remember the time, quite a long time ago now, actually, that our team asked one of the generative models to describe our MREL policy in the style of a pirate. And the response was just fantastic. I think it might have also been the first time I truly understood our policy.
Would you like to do an impression?
Yeah. No, I can't. I'm not going to do my pirate impression.
Oh, come on.
Thanks for attempting.
Later on this evening.
Later on this evening, I will offer that. But the serious point I want to make was this, that I am gently skeptical about the idea that we need a lot of financial services specific AI regulation. There is, I'm sure, a place for wider AI regulation, but we've looked very carefully at our regulation. We've tried always to be technology agnostic. It is true that the banks and the insurers are asking us to elaborate a little bit here and there. So what are reasonable steps if you're a senior manager who's got responsibility for one of these models? And okay, I think we can do a bit of that, but where I'm sat at the moment, my instinct is not that we need a kind of big extra financial services AI regulation layer. There may have to be something up here. We may need to do some little elaborations here. But I think if we do this, we're going to have this in here, we're going to have this in energy, we're going to have this in health. I think it'll be a mess.
Christian, as a practitioner, are you encouraged by the tone you're hearing from the
absolutely.
lawmakers?
I think, in particular, what Sam just said is absolutely true. And to your question, opportunity or threat.
Yes.
In my view, it's an absolute must-do.
Yeah.
Forget even opportunity or threat.
Yeah.
If you are not there, you're gone.
Yeah.
And I even start, forget about as a bank. Look at the demographic development in Germany, in most of the western part of this world. Without AI, we will not be able actually to replace all that. What is, so to say, from a pension and aging point of view, going into a certain direction. So we should really embrace it. From a bank's point of view, you know, it helps us on all three topics. For sure, revenues. Why revenues? Because it's a client experience which is far better than the old part. Think about the call centers which we have in the private bank. I can tell you by heart the 10 most questions which are asked from Monday to Friday, and just the level of preciseness, responsiveness, no waiting time on the call. You can actually increase the client experience, which always has a positive impact on your bottom line or on your top line. Cost, I don't need to argue that. But I think, and there we need to have the good discussion also with the regulators, and I understand that we need deep discussions. We are running a lot of test runs in AFC, in KYC, with AI, and our results are actually very, very encouraging. Now, I understand that this needs to be done together with regulators, but I think the control areas and the control levels of banks can be even increased if you apply it to the right standards.
Interesting. Just before I come to the kind of policymakers for reaction to that point, you just want to tell us something that I mean, you mentioned call center kind of servicing and stuff, but something really exciting that you think AI could change.
Exciting is, look, David Volker-Zlando may not like to hear it, but it was actually his idea. We are now putting AI in Deutsche Bank research to go through the research reports. What today are kind of the analysts, the young analysts are doing, the way AI can actually scan through all these reports, think about the conclusions. We are trying to think about how can we then make the result, not that there is no human being anymore involved, but to actually come up with a structure, come up with a comprehensive summary, come up with a faster response to our clients. It's a real exciting project. AI in human resources. You can't believe how happy people are if they call, our own people call actually the human resources hotline, and they get more precise and clear answers to questions they have than before. So it's not only client related or investor related, it is also the way you run the bank.
Yes. Irene, you wanted to come back?
No, if I may, of course, there are tons of opportunities for banks' profitability, new markets, more efficient management, etc. But as a policymaker, I have also to ask myself other questions, and I'll give you just a couple of examples. I'm often approached by not only by bankers, but also by citizens, entrepreneurs, small and medium business firms that have problems in relating with banks. When they're accessing to mortgages or loans, or so they come to me. And for example, recently I had women's organizations and women entrepreneurs coming to me and reporting me problems that they've had in accessing credit from banks. They were small, very, very small entrepreneurs with 3-4 employees at the very beginning. And one had denied, she saw that the bank denied access to credit because it said, you are in your 30s. What happens if you get pregnant next year? Will you be able to repay? Okay? These things happen. Okay? We may be shocked. We may say, oh my God, this is terrible, but they are happening. Okay? So what happens if things like that get inside the algorithms of the AI when we have to decide who to give credit to or not? What happens to that? As a policymaker, I feel my duty, my responsibility to make sure that this is not happening.
Yes.
Because my prior objective is not yours, is not making the bank profitable, but is to make the European Union the union that I want to have in terms of value, in terms of protection of the citizens, of women's rights, of everything. So, and I'll give you another example. I had associations, like business associations, LGBTQ+, they were worried about the implications of AI, for example, in insurance. Because what happens if we end up being labeled as riskier for some aspects? There are lots of prejudices. this could happen? How do we know that AI is not becoming an instrument that ends up deviating us from the European Union that we want to build for our citizens, for our entrepreneurs, for minorities? So I think these are questions that I understand you might not be so much worried about, but it's my duty as a policymaker to worry about these things. And so this is the kind of debate that we have in Parliament when we talk about AI, just to provide some examples. Okay?
That's really interesting. Do you want to come back very quickly, Christian?
No. I think, I just said, in particular, when it comes to controls, but others, we need to work with the regulators and the policymakers. But, the world, as we said for another topic, the world moves on. I was just in China. I was in the US. The application of AI over there is dramatically higher than in Europe. And we see where the investments are going. Capital market share in Europe versus US was 20% 15 years ago. We are now at 9%. So we halved. We need to see that this is happening. This doesn't mean that we need to be cautious about that. So I agree there.
Yeah.
The move.
Come in with a
I just. It seems to me that it is not in the interest of Deutsche Bank or any bank to create an AI system that discriminates customers. It's not good business, and I would think that the incentives are there for Christian to worry about this sufficiently that it doesn't happen. Then there are things of risk management that may arise from this that I'm sure Frank and Sam will be eager to think about. And at this point, and apart from the issues of existential threats from AI, which are sort of general of nature, not in our field specific, I at this point don't really see yet. I think we need. We are far too early to form a picture of whether there are some sector-specific regulations that are needed in this field. So far, I've not seen any.
Okay, great. I'm conscious that there would be questions from the audience. I'm very keen to involve you. I'll come to you. Do prepare your questions in your heads. I've got one that I wanted to put to Frank and Sam, actually, from an online question. And it's to do with climate, Frank, because I know this is an area you're very interested in. Do you think it's realistic? And sorry, it's a slightly techie question, but all the more important for that. Do you think it's realistic to include climate-related and sustainability factors in estimates for probability of default and loss given default calculations? And if so, how could it be done?
All right, well, thanks for the question. I thought, when is this question going to come now? Finally, but here it is. What I normally do when I get a pretty technical question to also make sure that it's palatable for everyone in the room is to maybe just zoom out a little bit and remind me of all of us of a couple of things. So we talked a lot about regulation. There is a European climate law, that there is a Fit for 55 strategy, there is a Green Deal, there was a Paris Agreement almost 10 years ago. The climate law says 55% reduction of CO2 by 2030. The Paris Agreement, as we know, says as close as possible to 1.5, but under 2. We are today on a 3-degree scenario worldwide, and the predictions for CO2 emissions by 2030 worldwide are not minus 55, minus 45, or 0, but plus 8.2%. That's where we are today. Now and I'm going to state this with so much emphasis that I'm just going to say it twice. This is how I normally do this. We, as a supervisor and as a central bank, we don't make climate policies. We don't make climate policies. We take them. So we look at the Paris Agreement, we look at the climate law, and we see that these create risks, transition risks. And we look out of the window, and we see that there's a whole bunch of physical risks. And I don't need to mention those. That's what we do. So we don't make climate policy. We do what we have always done, and that is we make sure that banks manage their material risks. And we now know Not all the banks still. So I'll come back to that in a second. But we now know that climate-related risk, and by the way, also nature-related risk, are material. So they need to be managed. So what do we do to help the banks to get to doing that well and adequately? We have a multi-year strategy because this cannot be done in a couple of days, logically. So we published a guide already in 2020 with our supervisory expectations in terms of managing, again, risk, climate, and environmental related risks. Then we asked the banks in 2021 to do self-assessments. And the banks have been commendably sincere, because they came back to us and they said, well, we do not comply with these expectations as of yet, which I thought was completely logical. So we asked, how much time do you need? And then 80% of the banks under our supervision said, give and take, give us to the end of 24 and we will get this done. We will be able to comply fully with all your expectations in your guide of 2020. So then we thought, you know what? If that is what 80% of the banks feel that they can do, we will create a level playing field and we will make sure that all banks do this and we will not have any hold-out banks, etc. So then we embarked on a thematic review, which normally we take, a sample of our banks, but here, because we felt that this was one of our key priorities, we asked all the banks. We went to all the banks and we checked, this was in 22, we did a bottom-up stress test, we did a number of on-site missions, we have done, and we have published also crucially, good practices. Because the good news is that already 1.5 years ago, all of our expectations, at least, there was at least one bank, and these banks have been in different jurisdictions, different sizes, different business models, that complied with one of these expectations. So all of our expectations, so to say, were being complied with, at least here and there, by the one or the other bank. So we knew and we know that it is possible. We just haven't found any bank yet today that complies with all these expectations individually, which is okay, because we have this process. Now, and here I want to tie in, and then I will stop, with what I said earlier about supervisory effectiveness. So we said, we are not going to wait till the end of 24 to then in 25 check how things have gone, and then maybe in 26 start thinking about how do we make sure that those banks who have not been able to comply are complying. So we set a number of interim deadlines. And we announced that years in advance, in many speeches, press releases, you name it. And we set the first deadline, interim deadline, for March of this year. And what we asked was to do, and I'm going to be a little basic here now, but to do what is actually the first basic step in risk management, and is do a materiality assessment. And those banks who actually did that well, they all came to the conclusion that this was material for them. What we have done is those banks who did not deliver that on that first interim deadline, we have now started in this escalation ladder that I said before, and that might, but might not, depending on how, in the coming period, they will, start walking faster, might in the end also lead to periodic penalty payments. That goes into what I said earlier. We want to be an effective supervisor. We want to be a predictable supervisor. We want to be a reasonable supervisor, but we also want to be an ambitious supervisor with impact.
And so the end point of that, though, does that translate into a risk-weighted asset calculation?
In the end, so I haven't said anything about capital.
No. Which was the question?
I tend to remember the questions. But I wanted to make so clear that this is something that banks can do. This is something that banks must do. This is something that even if there was no supervisor, and if you were to just manage your risks, you have to do. And I'm pretty sure that we will be able, and there is some passion here on this, but we will be able to deliver together a European banking system that is able to manage these risks. Now, to say one thing on capital, I think this is not immediate at all, but it is true that our whole capital system is based on if there are certain risks, they need to be well capitalized.
Yeah.
So from this institution, we have always been against green supporting factors and things that can, that let go of a purely risk focus. Because as I have tried to underline, I think rather emphatically, this is all about risk management.
Yes.
Now, to stop, there is one more risk, and this goes way beyond what I've just said. And you will see if you look at the scenarios that the NCFS, the Central Banking Supervision Network for the Financial System, produces, scenarios that we use. There's a disclaimer there, and it's small, and it looks legal, but it's important for all of us. The disclaimer says that we might be underestimating seriously what is coming. And I think that we all should worry about this, not only today, but also tomorrow and in the years to come. Climate scientists tell us that it is not unlikely that certain tipping points have already been passed. That means that things are locked in, even if we stopped emitting today, which we are certainly not doing. We always talk about the things that are still needed to make it. So today, Christian, you said, banks and governments will not be able to come up with the 500 billion. So we need a green CMU. Thomas, you have just told us that's not going to happen.
That's not what I said.
Well,
sorry.
Okay, but you said it's much more difficult, it's going to take time,
Yeah.
it's going to be... So is that going to happen to 500 billion extra investments this year? It is not. Is it next year? No. The year after? No. Maybe 10, 15 years from now.
But it
so
is
this
far more
clock
urgent than that.
is ticking.
Yeah.
So the only thing that I'm saying to all of us, that little disclaimer there might come to haunt us.
It's a really important point. Sam, anything to add from your side? And then I want to take some questions from the audience.
To the narrow question,
Yeah.
my answer is yes, but not very well. I say that because some of our banks are already doing it under Pillar 2 for their mortgage exposures.
But it's something that you're going to increasingly kind of
it's early stage, but the more forward-thinking amongst our banks are already attempting to do those calculations for the purpose
of their own bats.
Yeah.
Okay, very good. Okay, questions from the room. Raise your hands if you would like to ask anything of any of our panelists. Have we answered every question that you might have? Surely not. Yeah, please. There's a microphone just coming. Andres. Yeah.
Andrea Stormwood, as nobody was asking a question, I'll ask a quick question. To what extent, and you, Patrick, you just call on whomever you would like to call. Looking at AI and having spoken about other continents being so far ahead of us, to what extent is there the potential of a dependency coming our way, and how much of a problem is that potentially?
It's a very good question. I suppose it's been prefigured in other sectors. For example, our historic dependency on chips from certain parts of Asia, for example. Do you want to take that?
Well, thanks, Andrea, for the question. The other good example, recent example, is cloud. Yeah. And the response within the European system has been DORA. We've got a critical third-party thing just coming forward in the UK. So essentially, from the financial regulator's point of view, if the parliamentarians agree, the instinct is to think if something becomes really big and really systemic, then you need a little bit to add to the basic principle of it's for the banks to manage their own suppliers. You might need a little bit extra to reach over and say, you need to play ball in our cyber stress tests. You need to be able to do X, Y, Z. So I think if it developed in that way, to me it seems quite likely that that AI dependency would become part of that frame.
Very good. Irene, do you want to add something?
No, I don't have much to add, except just one thought, because we discussed the regulation in terms of AI and everything, the fact that we are behind. But just as a reminder, the regulation is not operational yet. So if we are behind, it's not because of the regulation. So maybe we also sometimes have to think about why are we lagging behind, because every time I hear we are lagging behind on innovation in banking, in fintech, in AI, and always we blame the regulation. But in this case, we still are working on it. So it's not our fault. The thing is that maybe we should have also an honest conversation about how come that in the European Union in general we have, but I know it's a completely different panel and a different conference, but how come that in the European Union sometimes we struggle in developing innovation, breakthrough innovation that can penetrate different industries and put ourselves at the frontier of the innovation. I think this is a conversation that it was much more fashionable in Europe like 15 years ago, 20 years ago. Now it's a little bit under, and maybe we should resume that, and instead of just blaming the regulation and just work together in terms of what we could do to spur investments, innovation, research, because we're not talking that much about it, but we are lagging behind, not just in these, in many aspects. And so
it's a crucial point. Yeah, absolutely. We are nearly out of time, but like many panels before us yesterday and today, I think several of us wanted to finish by paying homage to Andrea and his time at the helm of the SSM. Just speaking personally as a journalist, I've never come across someone who has been so respected by journalists, by analysts, by fellow regulators, but also by the industry. It's quite an achievement. So I think applause from me on that. But I know, Sam, you wanted to come in and say.
Thanks, Patrick. I'll say a quick word and then maybe pass to Christian to finish. But Andrea, look, everybody knows you've been a brilliant leader of the SSM, a brilliant leader of the EBA, and a totally committed European. Let me add something more personal, which is, as you mentioned last night, the first time we met was in 2010, when we were looking at the question of ring fencing in the UK. And I came away from that meeting thinking, this is someone who's very wise, very wise. I remember what you said, actually. You said at Banca d'Italia in your youth, you had some experience with activity-based restrictions, and it was not a very positive experience. Unfortunately, we did ignore that advice last time I did that. A couple of years later, I realized also that you are very courteous, because probably what you were thinking in that first meeting was, wow, this guy doesn't know very much. But that was not apparent to me at the time. And then as we've worked together since, the other quality that I really admire in you is you are incredibly tough, very, very tough. And I think that's a fantastic quality in a supervisor and a regulator. So I've always thought of you as, if you like a wise uncle to give advice, to guide. Usually when you lose an uncle, it's a permanent loss. But luckily in this case, it's not permanent. And indeed, you've seen the light and you're coming to London. So we look forward to welcoming you there. But I'll pass to Christian.
Well, we had already the opportunity in the EBF, but I have to say all that was said before is really true. I think you are a super highly respected regulator among us banks. Also, when we have the one or the other situation where we had a different view, and there I can say, yes, you have been tough, but I think that's your task. And at the end of the day, I always measure people when there are tense situations, Andrea, and knowledgeable, all that, of course. The way you behave when it comes to challenging and critical situation, you listen, you think, you are very clear, you are calm, but you are also pragmatic in those situations. And that we all appreciate, and therefore we always felt very safe with you.
Well, Andrea, we've probably embarrassed you enough. But on that note, thank you, and thank you to the panel.
Thank you to the last panel, very interesting discussion. Thank you for your homage to Andrea, and thank you, Patrick Jenkins, for moderating. So now, last but not least, of course, we come to our final session, a conversation between President Lagarde and Chair Enria. I give the floor to the President.
Thank you very much, Connie, and good afternoon to you, Andrea. I think a test of your fame, popularity, and success is actually the room. Not everybody can see it because a lot of people are watching from online, and the room is full, which is quite staggering after a day and a half of all this hard work and great debate.
Because you came, of course.
No, rubbish. No. Nice. Witty and thinking of you on your feet as well. So you've been showered with compliments like hardly anybody I've seen, even upon leaving. And I'm going to ask you some really quick questions, and you're going to have to respond quickly as well. So, what is your best memory?
My best memory of these 5 years? I would say the start in town halls. Meeting with the staff, listening to them, understanding what was working well and what maybe needed to be changed.
Okay, what's your worst memory?
Worst memory? Well, we all have bad memories of the pandemic, of course, but I would say, honestly, that the most tense period has been the spring this year. Now everybody has been saying, how well the European banks have done, how good we have been. Let's be honest, we have been very scared about what was happening this spring. And when you see deposits flowing out of the banks, as a supervisor, you start really freaking out. And so that was tough.
What was your most difficult decision?
Well, in these 5 years, of course, the decision on dividends has been very difficult and painful, no? Because, of course, what I would have liked was that the banks themselves had decided to show some restraint and refrain from, paying, distributing dividends and doing buybacks in a moment in which there was such a radical uncertainty on what was coming. No? We had an unprecedented shock. We are seeing projections of GDP negative growth of 14, 15%. So, and still, while moral suasion seems to work in national environment, European Union is still a rules-based type of community, so if you don't come with a hammer of a recommendation, things don't happen. So that was a difficult decision, but I think that although some people also in this room I know disagrees, I still think it was a good decision.
So did you have to come down with a hammer?
We did, yes. We had to come with the
How did you use the hammer?
Well, it was simply basically a recommendation. Agreeing on a recommendation, deciding, issuing, and this delivery. And I remember, honestly, let's say, you don't like to use I don't like to use this hard power. I would have liked much more the soft power of, banks seeing the value in doing that. But eventually, I remember that day there was a respected observer of banking issues that tweeted, ECB recommendation not to distribute. All banks say yes, sir. EIOPA says insurance companies you should not pay dividends, and
insurance
companies also from some national authorities, insurers paid dividends in several countries, not all countries, but in some countries. So that conveyed, in my view, and it's not a criticism of EIOPA, of course, that did a very good job in pushing that.
Petra is not in the room, it's okay.
But anyway, the point was that, that was a very visual, representation that the banking union was there and delivering, And
so the banks did not disappoint you at that moment?
No. Well, disappointed me because they didn't follow moral suasion. I would have liked that, but anyway, eventually, of course, when we came with the recommendation, they did what what they were asked to do.
Those who know you well would argue that at that point in time it was a test of your decisiveness and you lived up to the test. Would you agree?
Yes, I mean, I must say I remember very well when I started, let's say, the last phase in 2011, this work in supervision, when I became chair of the EBA. I remember the interview with Michel Barnier, when he was selecting me. First of all, it was one of the most difficult interviews ever, because the evening before I was told that Michel Barnier didn't want to do the interview in English. So he said, can you do the interview in French? I said, oh my God, I cannot. So that was a bit of a, but eventually we managed. But when he came out, he said, you will have to be very strong in this. You will have to show decision. You will have to show, spine. And it was, tested very, very, very early on, and I learned it's difficult, but as also Sam was saying, in this job you need it, and so I'm glad that you say it. I think that I don't shy away when you need to take difficult decision.
No, absolutely. Take us inside the boardroom when that was on your mind and you decided that it was the right way to go, given that moral suasion was not working. What was it like?
Well,
all right, board members are shaking here.
The boardroom, we have to remember ourselves, was my room at home, because we were all working remotely.
No fear, yeah.
No, but I would, let's say, I think the process was first, let's say, all the discussion individually with the bankers and then with the European Banking Federation that organized the meeting with the banks. That didn't go as I expected. But then I discussed bilaterally with most members, and then we had a meeting. And eventually, there were different views around the table, but I think, and I was discussing with the board this in our last meeting. I think that, let's say, we have been very good at coming at consensus. Also, when we don't have agreement, when there has been such a good quality of discussion amongst us that eventually everybody can live with something that is seen as having strength. So the decision was not difficult. I had some difficult discussion with some individual members. Some of them will remember it, but eventually the decision was not difficult.
So what tools did you have that you wish you would have used? Not necessarily in this particular instance, but in general. You have a toolbox, you have used many of them. Are there tools that you wish you had used a bit more? And are there tools that you wish you had had, but you didn't have? I'm thinking about Claudia, who is going to take over from you. So she also will appreciate the advice.
The remark I was making before on moral suasion is an important one. We lack this tool. We do have it with individual banks. So our supervisory teams, when they engage with individual banks, they have leverage and they can convince the bank to do things, and sometimes the bank is not convinced, but still sees the benefit in doing it nonetheless. But when you talk to the industry, to the sector, sometimes it's difficult, because I understand that that's the point in which you are a banking union, at least on the supervisory side, but you don't have the government side also in the room to some extent. And that can be an element of, and the type of environment at the national level means that people feel more obliged to follow what the supervisor says, because it's a community. Here, banks bring us to the European Court of Justice without a blink of an eye. In national situations, this doesn't happen very frequently. The bank feels a bit reluctant, to challenge in court the supervisor, and that's a difference, and we have to learn to live with that. That's the environment.
So what's your track record before the European Court of Justice?
Well, Frank maybe would be a better place to reply. We lost several judgments, And I think that, and Frank says this, and I'm totally 100% with him, bring them on. I mean, eventually, if the banks are right, if the court says that they are right, okay, we'll learn and we'll adapt the way in which we behave. But I don't think that we should shy away from taking difficult decisions because we are afraid of losing in court.
So see you in court is fine?
See you in court is fine.
Okay. So, okay, well, it's true to character. That's good. So what tools do you wish you really had and you don't have in the toolbox?
To be honest with you, it's not that...
and everybody else. Huh?
I mean, it's not that we have tools. I don't think we are lacking tools. I think the tools that we have in our funding regulations are the right tools. The key problem, I think, and this is what is making me a bit upset, honestly, on the discussion, for instance, now on crisis management, is that sometimes we have the tools, but because of the concerns at the political level from the legislators when the regulations are made, we try to put all the possible constraints to the authorities to not enable them to use their tools with sufficient amount of discretion. So, for instance, when we take deposit guarantees, I mean, I'm not talking EDIs, we have done enough of that. But let's say with the current amount of funds that we have in the European Union is in the same ballpark of what the FDIC has in the US.
Right.
Same ball. If you take
but it is scattered all over.
It's scattered all over, but single resolution fund plus national deposit guarantee schemes, same amount of funds.
Right.
The problem is that because of, different willingness to preserve national specificities in the way in which you use these deposit guarantee schemes, or fear of activating too much a single resolution fund, which is the only mutualized part of our safety net, we put so many constraints that whenever we have a crisis coming, we cannot touch basically a single euro of this funding, and we have also, so this means that we have very, very short time frames to try to find a solution to this crisis. And honestly, that's something which is difficult. And we have an excellent collaboration with the SRB. We prepare together, we work together, and so far we have delivered. But again, sometimes these concerns, that everybody wants to preserve the national bells and whistles, makes our life more difficult. We have to activate 21 different legal systems when a bank goes into a crisis. And honestly, we had the crisis of Sberbank, plain vanilla, a bank that went bust just because it was Russian after the invasion of Ukraine. But still, we had to, find a way in Slovenia, where the bank was the fourth bank in the country, a way in Croatia, different way, where the bank was the third bank in the country, different in Austria. It's not making our life easy. So having a little bit more, these tools that we have, making them more available, easier to use, and trust the authorities. We set up these European authorities, the SRB, the ECB, trust the authorities instead of tying our hands in the legislation.
Okay, so that's one of your wishes for the future,
yes.
that can be fixed and addressed. Yeah, okay.
Skeptical though.
What would you like your legacy to be?
My legacy, I think that there are several things I'm attached to, but the most important one, in my view, is breaking the silo culture inside the ECB and between the ECB and the national authorities. I think we have a fantastic firepower in terms of technical skills, in terms of people who really knows the job, is passionate. So enabling the pooling of these resources in the SSM across the whole collective house we have, and give us much more effectiveness, much more impact. So we have started doing that. We are not yet finished with the job. Internally, we did the organization. We have an integration agenda with the national authorities, but still a long way to go. And we can be even better, but I think I'm proud I initiated this process.
What I can say, that's outside the interview because I'm not asking you to opine on that, is that the cooperation between the SSM part of the house and the central banking part of the house, not just through shared services, but in general, in terms of substance, intellect, sharing of data, has been fantastic. And I would like to thank you for that.
You have to let me speak a bit about that, because you are deviating from the script that I thought you were following. So
I don't. For you all to know, he doesn't have my script, because I just made it up.
No, so basically, the first point I wanted to make actually was stressing the point you made yesterday, which for me is very important. No, because let's say again, sometimes I'm old, so I've always been a strong believer in having supervision within the central bank.
Yeah.
And actually, I've seen in these years the value of having that. And again, if you had asked me, as I was expecting you to ask me, that how we managed this series of shocks, I think that what was fantastic was exactly to tear down these firewalls between the two sides of the central bank, to mobilize the extraordinary intelligence that we had in understanding the economic environment, how it was changing, getting the statistics we needed on the sectors hit by COVID or by the invasion of Ukraine, pulling together people, junior people also across the house, and making them work together and preparing, spot-on analysis, real time, people working the nights. You remember that, also during the spring. That has been fantastic. And I think that, honestly, and this goes to your merit, Christine, could never happen if they didn't see this type of, contact relationship between the two of us, and if it was not also for your leadership that I owe a lot to.
You're much too kind.
No.
So, looking back at all these years, and not just the last 5, but looking back, if you were to advise a young graduate in, let's say sciences, anthropology, or economics, what advice would you give for his or her future?
I do that quite a lot when I go. I have meetings, with young graduates in finance, or with student university when I go in my country visits sometimes. And the simple thing I tell them is, well, consider becoming a supervisor, because all these skills that you mentioned can be deployed very effectively in supervision, including anthropologists. It's a job. I tell the people always, if you look at the payoff of being a supervisor, it's terrible, because if you do your work very well, nobody notices, and if you do a single tiny mistake, you are slaughtered, in the streets. So people should really run away from a job like that, right? But instead, all the people that start entering this profession eventually become so passionate about it. That's fantastic. And you can deploy all these tools and come to know real life challenges that you can see in few other professions. So I really try to use these arguments to get a little bit more incoming stuff in our collective organization.
There was a few Netflix series that were instrumental to encourage young people to move in certain professions. Formula One is an example, but there were a few others. Do you think we should encourage Netflix to look at supervision?
Why not? Usually,
Would you accept to star?
No, that's not something I would do well. Honestly, I know my limits.
That's true to character as well. No, you don't. So the time remaining for us, my dear friend, is an hour and 15 minutes. You okay with that? No. So I think we have to come to a close because lunch is next. I know you're not going to take up yoga, but what thing will you do wherever you go next, which you haven't had a chance to do so far? And I'm not asking you whether you have any regret. That was on my little list of questions that I put for myself this morning. Because you clearly have no regret.
I mean, in The Guardian, there is this column that is now starting life after 60. And you have all these very inspiring stories of people that, after 60s change totally their life and do something totally different. Well, I'm sorry to disappoint. I'm a boring person, and my main ambition is to continue doing the same boring work from a different place, maybe, but
Shall we applaud this boring person that we like so much?
Thank you. By the way, I need to say it. I thanked already a lot of people, but I think I missed the two most important people that supported me in these 5 years, 4 years for you, Christine, and 3 years for you, Frank. I think that, again, as we say several times, this is not an easy job, no? And you have a lot of people working with you. But eventually, when you have to take the difficult decision, everybody say, "Okay, this is on your desk." No, so you feel lonely many times, and having the comfort of coming at any moment to ask for your advice, and having Frank with his support and friendship throughout these years. I wouldn't have done it without you. So thank you very much to both of you. Thank you.
Thank you.
Thank you.
Thank you very much. Just to conclude, this does conclude the Banking Supervision Forum. Thank you very much. I invite you all to a light lunch outside the room and down the floor. Oh, sorry.
I forgot saying a thing, that, this event for me has been very interesting. I hope you enjoyed it as well. But let's say it wouldn't have been possible, of course, without Connie, without all the team that has been organizing, and Kerstin also has been in our board, leading the organization of this forum. So I want to thank you all for your excellent organization, and thank you all for participating. Thank you.
Thank you very much, Andrea. Okay, so lunch, everybody.